Good morning. It is September 20th, FOMC day. We're going to be watching Powell and trading some stocks, options, futures. Watching the SPY, GME, GNS, BBBYQ, AMC. Sub up, like up, comment down. Happy Money sticks around. Follow us on Twitter at HappyMoneyYT, as well as Discord server link for both those in the description. Still need to get stuff set up here. SPY will probably be pretty slow until 1:30 or so. Yes. Didn't like being below $1. Look at that thing. Hard to predict that rally. It bounced like right on our support though. That's crazy. 82 cents. Back up over $1. Probably not gonna be doing a whole lot of trading before. I might open up a strangle, but I'm gonna wait for the market to kind of chill out. Excuse me. Just get things set up here. Okay. Okay. Got a little gap up on SPY at 0.3%. Back up to kind of the highs that market yesterday. Right up into its range. GNS up 23%. See, GME up 1.5. Button up against this first little resistance line on it. Got AMC up 1.5. AMC is looking pretty nice still. CTI is up almost 10. My size up 7.5. No bounce on EBIX. Showing barbecue up 6. Not really though. It's still between its 19-cent, 60-cent barcode range. Got an open door up 4.5. Ends up 4.5. And some bouncy stuff. Hey, Mr. Invest, good morning. FOMC's at 2. Powell speaks at 2:30. Happy money's the best money. What's up, DVS? It's been a while, man. Alright. 30 minutes in. Thanks, guys, for your support. Sorry for the late start today. You guys are late on your likes, too. I've only got 4 of them. I wait. News on GNS. Check what. News Group teams up with Groove Digital and Groove AI for AI-powered education platform. I don't know if that's a catalyst or not. Maybe. See AMC keep rallying. We're still in barbecue? I think a lot of people are. So, morning guts. Hope you have a good trading day as well. See, the premiums on the daily options for SPY are pretty outrageous. So they'll stay outrageous up until like 2, but you will get some form of IV crush at 2 and then 2:30, kind of like earnings would. So keep that in mind. Given it's going to be volatile, so the way it goes is going to be good, but volatility is priced in. Well, I'm bearish for this FOMC. Got a lot of market crash plays by January. For solar, AI. This one's come down a ton, but my plays are so far out of the money. Still down a lot on it. I only have one of these. Scale in. The bullish play is Dish right now. Dish, Joan, Funko in my trading account. Dish is up 2%. Nice. Funko's still on a nice mention. Joan maybe get into a double bottom. Maybe. Joby's another bearish play. Lucid. Here. In. Up percent. Etsy up 0.5%. Beyond's up 1%. Rum's still selling off. Not sure what's going on. Maybe it's like insider selling or something. A lot of volume on it too. Down 2.7. Lockup period expires? Maybe that's what it is. Yeah, so that's insider selling. The CEO and founder, Chris Pavlovsky, said he has no plans to sell the stock. This is other insiders probably selling it. So once they're done, should see a nice bounce. These spies just chopping. Choppy chop. Chop chop. Low volume. High premiums. Teladoc. Flat. Space. No. Space down 3%. See if you can hold that support. down now. See if we get a little test on the lows. The only thing I considered was opening up a put at the high of pre-market, which I didn't. Fine with that, but the only thing I was probably close it down at the lows. At least some of it. Go, there's low of the day test. Morning, Sam. No, there's lots of people still in barbecue. Get a call there. I didn't have the didn't take the put at the top. $7,000 shares, let's go, baby. Yep. Yeah, there's a lot of people in chat still at barbecue. Sure of it. Guts does. I'll look for a high then to grab a put. Try and set up a strangle. Still pretty early though. You're low there on SPY. Basically just want to find the lows to buy calls and the highs to buy puts today. Prior to FOMC. Have exposure on both sides. Trying to get good entries on them. Double bottom. Maybe. I got a call there. I think it'll put up here. Wait. If we hit this high again or make a new high. Make a new low. Look for another call down here. But range could be pretty tight until FOMC. Oftentimes we'll get a rally just into it. So like 130, 145. We'll get kind of a hype rally for whatever reason. AMC up. AMC up 1.5. SLE up 7. Birds is down 30. Dude, Chewy just still getting wrecked. Crazy. Very ugly. This must be insider selling also after earnings. Three files for mixed shelf. That was 4 days ago. That's what started this. So yeah, they're offering shares. Maybe. See the volume pick up last 4 days. Jeez, Chewy. Bad time to be doing that. Busy Bee still in barbecue. You have 600 GNS. You want more? I don't know. Probably not. I'd probably wait for it to get back to $1. Still, it's under that kind of resistance line we have there, that 110. I don't know your plan or anything with it. But, yeah, I mean, it was in a downtrend. I think they did have that news that maybe what popped it up today. Yeah, a lot of volume on it already. 6.3 million already today when yesterday was only 2.5. Been having 2.5 on it, so quite a bit of volume. So yeah, it must be from that news. Yeah, all these stocks getting wrecked. It's either insiders selling or the company's selling shares. No, not like insiders. Hey, look at that. Liquor's down 3%. Petco's also getting worked. Celsius looks like it's about to take a long trip down. BFS down 1.7. Still like its trend though. ECB could be consolidating. See if it bounces on the 76 cents again. I head and shoulders on Tractor Supply. GME ever reverse split? No, it didn't. AMC popping back up into that range. 3.3. See if that turns into resistance. Buy slowly climbing back up to VWAP. Bar chart hasn't been working for me. Bar chart work for you guys? Oh, it's just the naked puts screener doesn't work. Weird. Groupon, dude. That thing held up so well. 2.5%. Wow. Hour into the stream. Thanks, guys, for your support today. We had a good morning. Good evening last night. Hump day. Today's hump day. We got 9 likes on the stream. Thanks, guys. Pretty slow morning, probably, until J Pow. SPY back up to VWAP. Above VWAP now. Is pretty much flat. See, holding up 4%. Right back up in that trend line, maybe. This is up 2.3. Excuse me. Where just flushing through its supports, down 1%. Back to 2020 prices. Red candle on there on SPY. Back below VWAP. GNS red candle too below VWAP.
that they're both still relatively new when it comes to the investor space, and they're in the early innings of their growth cycle. And so this analyst over at Needham actually initiated Lulu with a buy and a $470 price target. That's around a 19% move to the upside from where it's been trading today. Now, she is expecting double-digit sales growth in the next quarterly earnings results, and that the company's accelerating technical innovation will drive demand across its franchises and across the newer verticals. Like, it started to add in tennis and golf wear. And so this analyst also sees profitability rising for Lululemon as well. And we know that last week it actually got a similar note from HSBC, just talking about how it's in the early innings of its growth and it's got a lot of room to grow from here.
Okay. All right. They kind of have this thing in common where they're meeting in the middle, where Lulu starts out with the clothing and athleisure wear, and then they're trying to get into the shoe business. Hasn't gone quite as well as they had hoped. On starts in shoes, trying to move into the apparel business. I mean, even if you just go to the websites, they're like structured very similar. It kind of feels like you're shopping, you know, at like in the inverse of the other place to some extent. But that being said, still a good chart, Rick, even though Lulu's, you know, maybe not quite as hot, new, and fresh and trying to find new avenues of growth. The chart hasn't really broken down. It tried, but the bears couldn't really hold it down for too long.
Earnings are a big catalyst for this name, at least based on the past year. About a 12% plus or minus move during our last few earnings events here. But the smallest one was the most significant one. Our last earnings event brought us up 6%, but it also brought us above this red line, the 386 level. You can see we formed a pretty obvious ceiling around that point. We had a few excursions to the upside, but nothing really lasted at all. We've kind of struggled to make our way above that point. Now we can see we had that big break upward, new highs near 407, and today we're breaking above our trend line and our yellow 21-day EMA after finding some support at our orange 63-day EMA. So possible upside breakout here, momentum improving, trend lines are all pointing upward, prices above all three of them. So trending upward, more concerned about the upside potentially here. So 407, that's the point to watch to the upside. To the downside, our moving averages will act as support, but the main area, 386, that's really the line in the sand, because we've got our 21 EMA, our trend line, and our horizontal support all kind of lining up at the same area. That's the point to watch.
Okay. Yeah, it really has basically kind of pulled the trading into that range real tight. All the volume consolidating around there at 380. I like that it's got some historical reference too, which is the last earnings. And that's a good reminder. The earnings are really big for this company. So given that they're still a couple months away as well, perhaps the sideways grind is the most likely situation for this right now.
Perhaps. I mean, 386, if we get below that point, that would be the dangerous mark to watch.
All right. Little, you know, venture above that high volume area post earnings, but settling back down into it. So the pull of 386 or so for Lulu. I like that chart. All right, last one, Nike. Different analyst for Bank of America. Little waning expectations here on their end.
Yeah, waning expectations. Quick note on Lulu. We reported on that HSBC note on Monday, not on last week. But with Nike, this morning we see a price target cut at Bank of America to $110 a share. That still leaves around a 15% move to the upside from where it's trading today. And the analyst kept a neutral rating. He thinks that upward estimate revisions are actually unlikely this quarter. And one thing I'll personally be looking for this week is, ever since Nike learned in June that it just can't do it with direct-to-consumer sales alone, it started to bring back more wholesale partners. I want to find out how's that going for Nike.
I caught that pun.
Yeah.
Yeah, they just can't do it. The stock really is having trouble here, Rick, especially because, you know, there's so much alignment across the product line, but, you know, it's very bearish in what, intermediate term?
The troubles began here when we failed to take out our previous yearly highs, and since then we're down about 26%, just sliding lower and lower. Trend is down. Moving averages are trending lower, prices below all three moving averages. RSI, we had a little bit of bearish divergence there. Price was trending down, RSI was trending up, but we made new relative lows on the RSI yesterday, just by a hair, so that's been invalidated now. We did make our way back above the oversold area, but not looking very promising here. If we slip below 94, that was an area that caught my eye, that was around where we had a gap. That could open the door to this area around 89 based on our old lows.
Okay. You know, it arguably kind of goes in order, the quality of these charts, in order of like freshness and newness. On kind of the hot new disruptor doing the best. Lulu still, you know, is a groundbreaker. But then Nike, it's not that the products are bad by any means. It's not that people don't love Nike and have the same allegiances folks do for Lulu or whatever on. It's just that they've been around for a longer time. The growth is a little bit slower. And because of their big international presence, they're subjected to kind of more macro headwinds. It feels like that's maybe one way to describe these charts. On, definitely the winner in the short term. Thanks, Renita and Rick. All right, when we come back, still got a couple months until we hear from the earnings in the apparel stocks, but some interesting analyst notes. All right, up next, perfumes, little makeup. Coty up 5% right now.
Cody. I still dancing around. AMC back below that range to VWAP. We get some more exuberance on AMC. Yesterday, a big rally.
also has the younger demographic that they really cater to. But as someone who gave up wearing perfume years ago, I'm actually surprised at how strong fragrance is doing for Cody. So I guess maybe I need to jump on that trend.
Oh, surprise.
Well,
Check out Burberry Goddess.
hey, well, we're in studio all day, you know. It's not like, but then again, hey, you get a guest, but all right, yeah, I hear you. All right, thanks, Caroline, appreciate it. But maybe there is a market here for a middle tier cost business in the makeup and perfume department. Let's bring in George Tillis and Scott Durfee. Our panel smelling fresh this morning. Gentlemen joining us from Salt Lake. George, our senior markets correspondent. Scott, senior manager of trading and education. GT, what are you wearing this morning? You got a little. I know that Durfee's got Stetson on.
Yeah.
Am I right or am I right?
Well, something like that. You know, I have to feed the horses before I come do this in the morning, so you never know.
There it is. All right, Scott, tell us about today. Are we going to get some excitement here, or is the market going to sleep through the Fed?
Well, you know, I don't know. We probably might get some excitement. I don't know that excitement will manifest itself in the market, but we do know we've got some big stuff coming up from the Fed today. You know, there's maybe a few main things that investors should be looking for as the Fed comes out today. And the first one is maybe we should ask ourselves, will the Fed maintain its projection for, you know, 4 interest rate cuts in 2024? You know, Fed officials have insisted that they have intended to keep this benchmark interest rate high to continue to push inflation down. So, you know, we're currently seeing a rate of around 5.25 to 5.5. Another thing we want to know, how many Fed officials think that the rates have peaked? In June, only 6 out of 18 Fed officials thought that the central bank was probably finished hiking rates. And so, you know, we think that maybe some of that will rise to nearly half of the committee now. And so there's just a few things that I think that, you know, we need to be aware of here as we're taking a look at what's going to happen today. So, yeah, one of the things that Fed Chairman Jay Powell would be wise to do would just kind of be to replicate what he said coming out of Jackson Hole, you know, not too hot, not too cold, maybe a little bit just right. So we'll see how it goes.
All right. George, not too hot, not too cold. Is there room for lukewarm in the market right now, or does that just let inflation simmer?
Well, I think they're just going to let it simmer, OJ. Like I said before, I think we're in a good spot from a monetary policy standpoint relative to inflation. I think it's going to take some time for core inflation to start to trend even below the 3% area. So I think that's still a hang-up for maintaining rates where they're at. I don't think the language is going to change much, to be honest with you. Maybe there'll be some statement changes or language changes, but I think the policy right now is relatively balanced, neutral, contingent upon inflation. I actually looked at the federal funds probabilities, and we're not looking until June of next year where there's a cumulative probability of greater than 50% of some sort of a rate cut. So that's where we're at right now, and that's a long way off. You got to think about, 8 or so months away from the policy meeting today. So I think we're in a good place. Policy-wise, I think at the end of the day, the markets right now, and we're still stuck in that trading range right around that 44.50 area on the S&P. It's going to break in either direction. And we've been in a trading range effectively since July. And again, I can't say which direction it's going to move, but, I think at the end of the day, we have to look at the fiscal flows. I've been talking about this at least for the last month. And with some budget reconciliation issues that might come about near the end of this month, and of course throughout October, I think that's a fiscal drain and a fiscal problem, and that may create a situation where we see some retests of some of those July areas in the market.
Okay, so right now the market's been generally going sideways, but not for crude, not for bonds. What's your number one asset to watch here this morning, Scott? Real fast.
I think you should be watching crude. I think you should be watching bonds. I wouldn't take my eye off the dollar right now, too.
Yeah,
these flights to safety, might be something where investors and traders are going to be keeping a little bit near the vest right now. So, those would kind of be the areas that I'm focusing on.
GT, give me your number one. If at the end of this session today, or maybe on Friday, I could let you look at one security to know what happened, other than the S&P 500? What would you be looking at?
Well, I'm going to say I'm actually looking at Apple. If you follow that stock, it's not trading very well at all. I mean, they're really selling any bids in that particular stock. So I'm going to use that. I know it's commonplace to use Apple as a proxy for the market, but it's not trading well. And I think that may be indicative of where we're going in terms of the breakup or breakdown in the market.
No, you're right. It's been pretty sluggish. All right, good eyes. Thanks, team. Nice comments. Thanks, Scott Durfee. George Tillis. Thank you for joining MTL. Trading 360 with Nicole Petalides is up next. We'll see you this afternoon, 2 p.m. And don't miss our special Fed coverage, of course, when the FOMC goes live.
Bye, back to BWAP. More chop coming up on 11 o'clock. Still haven't gotten my my puts yet. So might get them right before 1:30, maybe 2 o'clock. Get a nice pump into it. No rush. These calls are just floating around. They're a little green. I guess I should have one actually. Yeah, doing small position sizing again. After 2:30, after he talks and everything, probably have to be sizing up some. Oh, they're on Rumble. No, the rum was rum's been selling off because the lockup period for insiders is over. So basically, insiders are selling. The CEO said that he's not going to be selling any, so that's good. But definitely some other people that are selling. You can see with all the pickup in volume too. Not sure how long it'll last, but once it's over, should be a good catalyst for a pretty good bounce, I'd imagine. Maybe even get some calls on it. Yeah, a lot of insider selling and share offerings going on. The one selling off is the other one. I don't know. Oh, Celsius? No. Woof. Wolf and Chewy. That looks like insider selling or an offering. Maybe just from their bad earnings. Wolf's chart is like never sustained a good trend on the longer time frame. It's pretty awful. Yeah, Chewy at this new lows. This is from a shelf offering, they said. Yeah. The Ryan Cohen valuation has been sucked out of Chewy.
Until noon this Friday, so another
Chennai.
to keep on our radar here. GM did respond in an emailed statement saying they are continuing to bargain in good faith with the union to reach an agreement as quickly as possible for the benefit of their team members, customers, suppliers, and communities across the United States. A Stellantis representative did refer to the company's latest website on the negotiations, saying that the company has resumed talks with the UAW and will continue to bargain in good faith until an agreement has been reached. Now, Ford, on the other hand, had their own news. They avoided having another set of labor disruptions as they struck a tentative deal with the union that represents their Canadian unit, which was reported late Tuesday. Now, Unifor, which is that Canadian union, did threaten to go on strike if a deal was not reached before Tuesday at midnight. The union does represent around 5,600 auto workers for Ford's Canadian facilities. So thankfully, they avoided that serious headwind here, as Ford does not need another labor force going on strike. But both Ford and GM modestly higher on the session here, so shaking off what seems like the market is just almost expecting this strike to continue at this point.
Yeah, and I know you've been covering all sides of this, and I just couldn't believe my eyes. I mean, I'm not surprised, but they were talking about vehicle prices going up 10 grand because of this. And so it's exactly what we've been talking about with inflation. Of course, the Federal Open Market Committee must be weighing that into their decision-making this time and the next meeting. Let's get to Apple and Goldman Sachs. So pausing the plans for stock trading on the iPhones.
Yeah, this is a really interesting story because we did see that Apple had been exploring this launch of iPhone features that would let users buy and sell various stocks in their partnership with Goldman Sachs. Now, they announced this morning then putting that on pause. The effort had not been previously disclosed, but reports this morning did indicate conversations over the investing feature did begin during the meme hype cycle back in 2020, with intentions to roll out by 2022, which of course did not happen. But this would have added to Apple's suite of financial products that is powered by Goldman. They did first join forces back in 2019 with their joint credit card, and then added a buy now, pay later loan and high yield savings account several years later. However, reports today said they had paused the projects as concerns have grown over potential user losses in the stock market, leading companies to pivot towards savings accounts with higher interest rates instead. Also, the move, I was reading from what the analysts in the street thought, seems like the move could draw some regulatory scrutiny, which is something that Apple doesn't want, given the fact that their App Store has been one point of concern for all things regulatory concerns, really. So this, to me, was an interesting news because we never really even knew that this was something in the pipeline, but now seeing that put on pause. And Apple is lower today modestly, but a name that's pulled back about 10.5% from its all-time highs.
All right. Thank you for all of that. Jenny Horn, great to see you. Markets correspondent. Let's get some insights in the news shaping the markets.
SPY coming down here a little bit more.
Chief economist at Milken Institute. Good morning.
50
Great
new
to
low.
see you. Thank you for being with us. Today is the day. It is Fed Day. Obviously, Fed. We've seen the tools
Not sure if I want
showing no hike
too
today,
many,
but you're
too
very
large of a
concerned
strangle.
about inflation and think the Fed better be watching very closely. Tell me more.
Well, Nicole, the last time the Fed paused back in the spring, what did you see happen?
Well, that guy has no accent.
bond prices start to price in higher and higher expected inflation.
Crazy.
The break even for 5 years, and the even more importantly, 5 years going out from the 5-year horizon to 10 years, the market started pricing in higher inflation because the credibility of the Fed's target of 2%.
If you were just talking to that guy on the phone, then you met him in person, would you be surprised?
The inflation rate was at 5%, and the Fed paused, and now it's at the core inflation is at 4.25, and the Fed starts deciding to pause again.
You hear it a little bit,
but the conclusion you have is that the Fed is really not serious about getting back to 2% inflation. So I think that the concern I have is that Fed credibility is going down the toilet fast.
Well,
AMC back to break even.
So as you're watching,
it really does move with the SPY.
To fight inflation, there are so many events that are happening. Obviously, we just finished talking about UAW and that the prices of vehicles could go up. We know oil's been at the
It's like, no, where's the guy you're interviewing?
And how about the
Who's this guy?
possibility of a government shutdown, which the Bank of America noting that the Fed could be flying blind in the November meeting, in which case they may have to pause again if they pause.
They're American white male?
Are they
Yes.
really going to make some, and that could be just the government closing could cause a slowdown economically anyway, right?
Well, Nicole, I think the most important of all the things you mentioned is that the one thing that you learn from a summer of strikes is that the labor market is absolutely not loosening. If the unions are demanding these exorbitant wage increases that are way beyond their productivity, the labor market is definitely not loose. And the other thing about the government shutdown is that you're right. If the data stops coming out because the government shuts down its operations, then the Fed will truly be flying blind. Now, usually when a government shuts down, it's just a pause where all the payments for wages will be paid back again. And so it really doesn't cause a real slowdown, except in terms of actual cash flow going to the government workers. But I think the most important thing you just mentioned is that the Fed has to reestablish the fact that it is serious about getting back to 2% inflation, because as I said, from the last pause till now, we've had long-term interest rates just gradually rising, and most of that rise is because expected inflation is starting to take off.
Yeah. What do you say to the folks who say rate cut in 2024?
Well, Nicole, I got to ask yourself, the only thing that'll cause the Fed to do what the market's pricing, that is maybe 3 or 4 rate cuts in the next year, in about a year or so, is that the economy's going to have to crash. And the only scenario where the economy is going to crash that seriously, that the Fed has to lower rates by 100 basis points, is the kind of oil shock that we really can't imagine, that oil prices go up, it causes supply shortages, and that will grind the economy to a halt. That scenario is very unlikely, but if that's the kind of scenario the markets are pricing, then the likelihood of that happening is probably very low.
Yeah, tell me about the bear steepening on the yield curve. You were talking about that. Explain to folks in layman's terms, what does that mean, and what's the interpretation, what it could mean for folks going forward?
When pros in the bond market start to talk about bear steepening, it says that, well, the confidence in long-term rates is that it's going up, and the short-term rates are not going up as fast, so that you have essentially a steepening of the yield curve because rates are going up in a way that is not healthy for the economy. Long rates are going up much faster than short rates, and that's the kind of situation where you run into that will really slow the economy pretty seriously.
And what about recession? Where do you stand on that?
When the data are so strong, especially for the Q3 estimates right now, and with unemployment rate at 3.5 or 3, between 3 and 4%, the likelihood of a recession being meaningful, that is causing people to not be able to consume and profits to squeeze, that is very unlikely unless we, as I said, see data coming in that shows the consumer is going to completely peter out, and that is really not there in the cards yet.
All right. Thank you so much, Bill Lee. It's wonderful to see you of the Milken Institute. Thank you.
Thanks.
Really great to chat about this on an important day, Fed Day. All right, coming up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes to the technicals. Kenny Polcari standing by. He's got the trades on Monster Beverage, Microsoft. Screaming buy is what he said. Bank of America. Trading 360. We'll be right back.
Okay, send out a Theta Farm message. That Theta Farm members doing a roll. SPY back up to VWAP. GME with a big spike there with SPY. Interesting. Big Eddie in the trading world. Really? Known for his small risk tolerance. You look him up? We can get another test of the high or anything higher than that. I'll probably grab a put. Might get 2 puts, 2 calls once we fully come into it. Hoping to maybe have that. I could have grabbed another call down here.
Development tomorrow from them.
So we'll watch for that. All right, let's get to the goodies. Of course, Monster, when you look at a long chart, like 20 years.
It doesn't go up.
It's unbelievable. It was a beauty. I should have known.
Yeah.
Just go with
We should have all known.
Yeah, what you drink, what you do. I mean, I should have figured that out. But anyhow,
it's in the energy. Well, it's in the energy drink space. You know that. They've got some key acquisitions. They're now moving into alcoholic beverages as well as specifically designed women's energy sports drinks. And we know that market is set to explode, right? So just take a look at Monster. It's backed off a bit from its high at about $60. I think it's backed off about 8%, which is only about 5 or 6 points. But it's in a very tight range. And I think if it holds here at the trendline support, which I suspect it's going to, then, you know, we're going to go right back up, right up to 60 anyway, and if not further.
Yeah. You know, and it did come out with its numbers, and then on August 7th, it had this large percentage increase, and Ben will see the candle right after the earnings. But what's going on with the chart today, Ben Lichtenstein?
Well, Nicole, we have seen a little bit of weakness as of recent in terms of Monster, but this could just be stacking up for another longer-term buy opportunity as the bulls have been handsomely rewarded for sticking with the trend on shares of MNST. Let's get into, first and foremost, the 30-minute candle chart. I've got a look at some of that weakness, a series of lower highs that have come into play, and how we still have really yet to reject this lower level, recently bottoming out around 55. Top side, left side of your screen there, you can see we're up around 59, and you can see on the way down. I went ahead and identified a couple of areas of consolidation that formed just to kind of get your eye focused on this bigger picture, overlapping rotational price activity that occurred around 58 and now currently around 56.20. So as long as we remain below 58 in this instance, still somewhat bearish, somewhat weak, right? Nothing to get too concerned about though when you take a look at this chart, and I like to kind of take a step back because as I mentioned, some of the recent selling we've seen, possibly just a buy opportunity, right? Because when you're looking at these areas of consolidation, if you're looking to participate with the trend, which has clearly been to the upside here as values moved to higher and higher levels going back to, we're talking the spring of 2022 last year, and we were trading around 35 all the way up to, again, recently around 60, you're looking to either, well, buy a opportunity, a test of a lower extreme that fails to break out to the downside here, or you're looking to buy that initiative move to the upside. So again, as we test this lower extreme, the bulls are going to be looking again back to, as I mentioned, that $58 level, back above 58, opens up a door for a retest of that $60 level. I just wanted to show you that longer term trend because Nicole, you mentioned how this is, Kenny, you guys are talking, we both, or all three of us should have known, right? Well, I coulda, shoulda, woulda, obviously, in this instance. Look, areas of consolidation that formed to higher and higher levels going back to, we're talking 2007. This is a stock, as I mentioned, that's handsomely rewarded the bulls for sticking with the trend in this instance.
Handsomely rewarded the bulls for sticking with the trend, and that's been the trend. I mean, you've been looking at that, Kenny.
Yes.
Right, and so that's what he's showing on this long-term chart. I mean, you just saw it up there. Final quick thought on Monster.
And it continues to, I think, impress, right? And continues to reward investors. And look, it's in a very interesting space. So as a core holding maybe, or as an additional holding to somebody's portfolio, they should absolutely at least consider it because I think it's in a great spot. There's a great sector.
Right. Okay. Let's get to the next one, and that is Microsoft. I teased it when I said screaming buy.
Yeah.
I didn't have
Pair fours, what the heck?
To say if this, if that.
Right.
Old tables card dead.
First of all, I own it, right? It's always part of the core portfolio of Microsoft, so I like it to begin with. And it's backed off about 10% from its most recent high as the market has kind of struggled here.
Picking up another call here.
And as we worry about what the Fed's going to do, what they're not going to do. And so I'm
I haven't had another opportunity for any puts.
If this backs off the trend line support at 315, then it's absolutely a back up the truck screaming buy type of an opportunity. Yeah. But I think a lot is going to depend on what we hear from Jay. So this one, I like it. I own it. I'm going to wait until after the press conference today to see how it reacts, depending on what J.J. Powell says, right? Because if he's more hawkish, then the pressure will remain on Microsoft.
Okay, either way.
More dovish, I think then this rallies right away.
Play pretty tight.
So don't do anything until 2:30.
I would wait till on this one. I would wait till the conference.
Okay, so let's get the news from the Fed, and then we'll make this decision. Ben, your thoughts on the chart, please.
Another instance, Nicole, where we're seeing a little bit of short-term weakness as we head into the Fed meeting, as we watch rates on the rise, the 10-year back to, well, inching its way up to 4.5% now. You got the 2-year above 5%, and well, taking a look here, first and foremost, at shares of MSFT. Microsoft, as I mentioned, has come under pressure. We're looking at from the highs last week up around that 340 level down to recently around 325. We went ahead and identified just 3 three areas of consolidation on this chart that have formed. One, a little bit
It's aggressive
more
low pair,
short-term
but
than the other two.
I don't know
You
if this
can
guy has
see, but
anything.
you can also see the overlapping, well-defined horizontal pattern that shifts into a vertical phase, and then it's just kind of wash, rinse, repeat. Currently in that overlapping rotational value phase, currently balancing around 328. If we were to take out 332, that's what the bulls are looking for, and I'm giving the benefit of the doubt to them in this instance. Still, why? Because of this chart. You can see on the 4-hour candle chart going back to the beginning of the year.
Probably don't have this with the jack low kicker.
Areas of consolidation in this instance. Now we are below the 335 level, but still holding up above the lows that we saw back in August, which coincides with that key area around 307, kind of the line in the sand in terms of this working assumption that areas of value continue to move at higher and higher levels. Bulls want to see this thing take out 370 and then form a new area of value at a higher level. Speaking of that longer term trend, here we're going back to 2018. You can see again,
we're flat. Isn't that crazy?
Into a bit of a double top, but I think hanging in there pretty well amidst what we're seeing in rates and some of the other headwind for stocks. I mean, to see shares of MSFT hanging out here, what are we just now, $40 off that high that we saw earlier this year? Definitely something to keep an eye on here. I agree with Kenny in terms of potentially the Fed could make or break this one over the next few hours here as we head into the end of the year.
Right.
Okay.
There's the straight.
Yeah. All right, Ben. Well, as we take a look at these charts, I mean, Kenny, it's unbelievable when you see the run-ups and you're looking at these. They're in different sectors, right? One is more a staple. One is more you're looking at technology.
Well, there's a full house out there.
And I like how you brought us a variety. I don't know if you have any final thoughts.
Anybody have a full house? I'm trying to call in. Hopefully they don't.
Chart before we get to Bank of
You
America.
might.
I just think
Oh my
Microsoft
gosh.
is one of those core names in anyone's
Full
portfolio,
house?
and
Dang
you need
it.
to take advantage when the stock is dislocated. I like the story.
I should have
Microsoft
raised
is
more.
cheap, so I'm not looking for this complete
Before the
disaster,
river.
But if it trades down to the trend line, you got to back up the truck.
This guy have a full house too?
I
think so.
Below the trend line. Okay, so we will watch for that.
Crazy plays.
Last but not least, when we look at Bank of America, we think about these financials and
Playing it tight, and in that hand, they were not playing it tight at all.
particularly in a higher rate environment.
Right.
But then we had the whole regional thing.
Right.
They just sort of went out of favor. I mean, this was a $38.
My all-in was to try and get them to dump, but they had a full house, so there's no way.
But look where it's been trading. It's been trading in that 28.30 range for a fairly long time. It is Bank of America, so this is not a regional bank, right? It's down. It's way underperforming, right? It's down 13% on the year versus its peers. But that's why I think it's even more attractive to me. First of all, I own it, like I said.
Yeah.
Down here, I've been building even a bigger position because I think it's kind of holding really tight. If Ben will draw
Guess I could
out
just check that one down.
that chart, and he'll show us how it's been trading very, very tight. I suspect in an improving economy, in a rising rate environment, that this should play catch up at some point.
I'm just trying to isolate this guy went all in.
And besides the fact that it's a 3.5% divvy, so they pay you for owning it as well.
Good point.
So I think it's just a good, solid story. Again, as a core financial holding, you know, it's that and J.P. Morgan for me, but.
Right. All right. So we'll give Ben the opportunity to take a look at this chart for us. Ben?
Well, we're going to have to go 2 for 3 here today, Kenny. Unfortunately, I don't see the upside potential in
Like
this
them now
one.
more
It
here.
appears to be still in this downtrend, not only on that shorter term time frame, similarly to the other two names we looked at, but also still playing out here in terms of the longer term time frame as well. Let's dive into, first and foremost, the hourly chart here. I've got 2 charts to look at here today, and shares of BAC and some of the weakness, again, as I mentioned here, on a couple different time frames playing out. Here we're looking at the move lower here that we've seen since the highs. They were trading up around 33. If you remember, end of July, you can see a couple areas of consolidation that have formed at lower and lower levels. Not a significant move to the downside, but value forming at lower and lower levels nonetheless, right? No rejection of that pattern that's playing out here. No indication that we've rejected this lower level. Bottoming out here potentially, but until we take out 31.25, in my opinion, this stock still continues to and has been and remains under pressure. And let's take another step back here. I just want to show you what's going on. Actually, I want to pull this chart up here because you can see this double top that occurred back around the $50 level in the beginning of last year. And again, we were just looking at the move lower that we've seen from this $30, $36 level all the way down to, again, recently bouncing around 30. But here you can see this has been playing out over the last couple years now, not just this year, not just since July here, and some of the weakness we pointed to on that more granular time frame, but here it is on the longer term as well, on the daily candle chart here. So basically weakness across the board here. Again, on that more intermediate time frame, you can see that we haven't rejected this lower level, and that continues to be the case here on the daily time frame as well. As long as we hold below 34 and even below 30 at this point, still kind of opens up
They
the door
folded.
for a retest
She
of the
gave it to me on the diamond
that we saw
below.
earlier this year. So yeah, and I don't really see anything to get too excited about
Below
here,
there on
mainly
SPY.
because we have yet to take out any of the significant areas that were established on the way down. Nicole, we're really just accepting this lower area of value now.
Yeah. All right. Ben, thank you for that. Always amazing on the charts. Let's see what Kenny Polcari has to say in reaction to your analysis today.
So listen, Ben, I love your analysis. I think it's fine. I just happen to like the space, and I like that name in the space. I've been using this level down here, right? I started, my average is probably right here at 29 bucks. So I'm not, you know, out of the money on it. I'm right there with it. But I think that this is going to be one of those banks that is so underperformed that when it turns, I think this one's got the opportunity to turn big. So I'm going to play it that way.
All right. I'm going to leave it right there, friends. For the big three today, we had Monster, Microsoft, Bank of America, and we thank you, Ben Lichtenstein, always for the charts. Thank you, Kenny Polcari.
It's always a pleasure.
For being here in person. Appreciate that. All right, coming up next, we're going to spotlight the cybersecurity space after hacks of MGM casinos and what investors need to know, and an eye on Klaviyo, not open yet.
Yeah, she took my chips and ran. Got lucky. That was an aggressive call. She could land to that full house in the river. Going all in on the turn. Maybe would have kept him out, probably, but I want to get their chips in there. I figured it'd scare him off. Look at that, made the flush. What? A flush didn't even win? It was two pair? Wow. Hold. Everybody. Hold. Oh, 4 ways and all in. He has pocket queens? Oh my gosh. Need to rebuy anyways. Give me some better hands. Go. Not necessarily a specific level. I mean, maybe this one right here. I might not get any more calls though. I already have 2. I was kind of only planning on having 1 and hit that level again, so I got another one. I'll probably wait. It's 11:30. We'll see where it settles. Could be here, could be pre-market levels, but not sure I want another call. I'm looking to get puts, so hopefully get a rally into it and then I can get some puts. But if I were to get calls, I would probably pick up one right now. I just don't see it being doing a big move before it, so why it's like, oh, it doesn't seem too risky to kind of pick them up wherever, just whenever you can get a good deal. Like normally these calls I would be down on them quite a bit. It was like you guys were saying, your puts, you haven't really gained value. My calls haven't really lost value, which is the nature of event pumped premiums. Maybe could have called that. Yeah, the IV. The IV is going to stay elevated until the event comes and goes. And you're going to get the crush. On a normal day, I bought calls here. Here, they'd probably be down more right now, but they're staying elevated because the expected move is large. Given they've come down some, but I think probably less. I just fold that? Oh, 420. I mean, you can trade it before it. Like, you could close your puts now and open up calls and try and just trade in the range a little bit. And not even mess with the FOMC. It'd be nice to just have some exposure. So if you did trade some now, you at least come into it with some exposure both ways. Or just with none, and then you can just... that's normally what I do. I have no exposure, and then I just, you know, when it pumps a bunch, I'll grab a put and just, like, scalp it. And if it dumps a bunch, grab a call and just get the bounces or the little reversals. Until it settles down, then you kind of figure out which way it's going. But going with a strangle works pretty well. Going on calls. Got a couple hours still, Corey. Ugly flop.
To what we've had for news for years around breaches. If you're a customer, are you particularly concerned? If a company has a breach, and you're going to buy their product. Generally, customers don't care that much. But if the product's actually unavailable, right? I mean, if I can't purchase these things, then obviously it's going to have an effect.
Corey, you're gonna get any puts, or
that's really the biggest
be long?
difference and the biggest change that's coming is that these attacks and these incidents are really fundamentally affecting, the way that these companies are able to provide their products.
Okay, so that being said, what kind of measures should be taken in your opinion, either by the companies and or folks in general? I'd like to hear both views.
So for the consumer, it can be tough, right? Because you don't necessarily control your data, right? You're giving it to organizations who are using it, in certain ways. And so that can be tough, right? It's tough as a consumer. But for companies, it's really making sure that you have basic cyber protections in place. We see a lot of breakdown with that leads to these issues. But also having a plan in place, right? I mean, especially with these new SEC rules, being able to ensure that you have the right communication path to disclose these things, that you're able to understand what the incident was so that you can, report that as necessary and really make sure that you have that incident response plan, right? So what are you going to do in the event that you have an issue like this that's not going to require you to shut down the whole organization?
And at this point now, when you think about the biggest hacks and the biggest possibilities,
I'll play a little bit, see if I can get some
all these
bluffers.
cybersecurity companies at this point. I mean, you even have companies that say, "Give me your 500 passwords, and we'll protect them
raise.
for you." And it sounds good.
Come on.
But I think people are just worried.
Nice, all in.
I mean, people are right to be concerned. As I said, it's also changed drastically in that a decade ago, not everything was connected. If you think about it, 15 years ago, if someone had told you
It's maybe a little too aggressive.
A computer issue could cause you to not be able to
There's an ace, you might call that.
Or not be able to order
folded.
dinner at a restaurant or something like that, you wouldn't have believed it. And
Too
so
aggressive.
everything has just become so connected so rapidly. And really complexity creates a lot of different vulnerabilities. And companies really aren't always ready for that yet. They don't really have plans in place for what's happening.
Mm-hmm. Understood. All right. Well, Alex Hammerstone, so great to see you. Trusted Sec. Thanks for being here, and a big story as well. All right, coming up next, the CFO of Klaviyo will join us. The IPO day, it's here, still indicated higher. We'll have more details live here from the New York Stock Exchange.
Another IPO. How's ARM doing? Selling off more. What was the other one? Cart? Ugly. Alright, send another alert out to the Theta Farm members. Opening up a position. Down a little more, retesting the low here. Excuse me. IP is up 1.3. GNS still up 17. Buy coming down some more here. Guess my puts on that double top was best entry so far. No, it was like one hand. I liked that table. Won't let you sell cart.
The company. We have never had more confidence in the business. We are growing quickly. We are doing it with efficient economics, and we are, have a great road of growth ahead of us. So we're just excited about the time period for the company.
Yeah, it really is a great time to come out because we've seen a great reception as ARM and Instacart, and we had Kava and J&J spun off Kenvue. So I think that, it just feels like the IPO window is cracking and people are coming out once again. It brings some excitement along with it. That being said, $9.2 billion, that's the value. Pretty hefty at this point. The competitive landscape, you compete against some of the really big guys like Salesforce and Adobe and MailChimp from Intuit. How do you, the competitive landscape, how does it look to you, and what's the outlook of the company?
Yeah, the outlook of the company is strong. We are focused on how do we deliver value for our customers. That is our number one differentiator, is that we deliver for them revenue in the form of something called Klaviyo attributed value. So what we're focused on, if you think about it, every marketer wants to be able to communicate, just like we're talking about, on a personalized basis. But that can be hard. And what Klaviyo does is it helps to make that easy for them. And so we're confident in the differentiation that we have in delivering that.
What I also saw, so we're talking about a lot of digital marketing, software as a service, and really data, compiling all that data of the customers. I was reading a story about Klaviyo over this past week, and it was about how, you would speak with not you specifically, but you would speak with companies, and they would have so many
two-pair, not bad.
If you ask sometimes a simple question about consumers or something, they didn't necessarily have that, and you're providing tools to do that, right?
That's right. We bring all of a company's data about its consumers all together in one place and make it easy to use that data to communicate with customers in a personalized way. We're proud we have over 130,000 customers, businesses of all sizes. Some names you may have heard of like TaylorMade and Unilever and Spanx and Crumble Cookies, one of my kids' favorites.
I saw that. Skims, Good American, Supergoop, right? A lot of good ones here. So
what are these companies?
130,000 of the world's most brands, and I'm sure just ever growing. What's the team and the employment picture, labor picture look like for the company?
We have over 1,500 Klaviyos. They are an amazing group. One of the things at Klaviyo is that we have a group of high-slope, ambitious learners, and we're aiming to make Klaviyo one of the best experiences of their career. It's the chance to be very entrepreneurial and help build a company.
Yeah, I saw over 1,500 employees, as you were noting here. As you accelerate, and this name actually comes from a Spanish word which means mountaineering pins, right?
Yes.
And climbing. Can you tell us that story?
The idea behind Klaviyo, it comes from a Spanish word for mountaineering pin, and the idea is a clavija is something that helps you do hard things.
Yeah.
We help our customers climb mountains, and the other thing that a mountaineering pin does is it has your back, and it helps you in case you fall.
Yeah, I mean, I think people really like a story like that, and it gets them closer to understanding what the foundation of the company was. When you think about the founders and when they put this together, what were some of the goals they were trying to reach and some of the things on the agenda even right now?
When AB and Ed were founding the company, they had been working with big enterprises, and they'd been working with big enterprises who had lots of data and massive technology budgets, but a really hard time getting that data all into one place to use it to speak to customers. What they wanted to do is they wanted to make that easy. They wanted to make
You
it
closed about 10
seamless and
minutes
simple.
ago.
And then importantly,
Thanks, guys,
they
for your
wanted
likes.
to bring
Appreciate it.
that to businesses of all
14
sizes,
so
not just
far.
big enterprises, but
Playing a little
everyone from
hold'em while we wait
entrepreneurs
for
to small
J.
and
Powell.
medium businesses, all the way up to the largest.
And I'd love to hear how your experience fits in this role that you're doing now. At the same time, when you think about Klaviyo and how it's growing and this vast amount of customers and companies that you're working with, it's pretty incredible. At the end of the day, you know, when you're balancing the books as the CFO, you've got to have a higher rate environment. You have wages that have been on the rise. You have transportation costs on the rise, supply chain issues, and not that
This guy's getting wrecked, man. And they're two Perry losters straight.
But I am curious to see, you know, how is it handling the books? What are some of the big challenges these days?
I feel so fortunate to get to work with great founders like AB, which is what we call Andrew Bielecki, our CEO and co-founder, and Ed, because they bootstrapped this business. And so they have always believed that you can deliver three things. We are going to be a scale business, we are going to be a high growth business, and we're going to do it with great economics. And they believe that it doesn't have to be a trade-off between that, that if you are creative, if you're building a great product, you can grow quickly at scale and do it in a really efficient manner. And that strong DNA was a gift coming in as a CFO, because it means that we're always focused on delivering.
I think I took that down. I don't know if Down's going to get there or anything.
Having that high growth vision and that positive attitude, regardless of the economy, to continue to grow. And I think also during the
Nice,
pandemic,
well done, man.
it also boosted companies.
Thanks, Christopher. Thanks, Guts.
Right into
Appreciate
the
your likes,
spotlight
guys.
very quickly. You know, I think a lot of people were looking for digital options, you know, digitizing their data, working with other companies.
Aggressive.
And we really got brought to the forefront very quickly during the pandemic, unfortunately, but great to get us into the next thing.
And what we found is that businesses want to be building digital relationships with their consumers. They certainly accelerated that during COVID, but we see this continual increase in people wanting digital relationships with the brands they love in a personalized way.
Yeah, and I'm so glad you were able to be with us on such a big day today.
Oh,
so right now,
don't get to see
the
it.
indication 36 to 38, so you'll keep your eyes peeled for Amanda Whalen, CFO of Klaviyo. Glad you were with us today, Amanda. Thank you very much. Coming up next, we'll check out those home builders, KB Home earnings, and much more. Get you ready. Trading 360. We'll be right back.
Close to the bottom pair with a crappy kicker. Could be a bluff, but oh, flush! I didn't even see the flush. Folded. Fine, climbing back up a little bit. Oh shoot. Thought I'd call any on. AMC up 3%. Yep, 0.8. GFS doing. GFS down 2.5. Stopped out. Had nothing? No one had anything? Pair of nines would have beat them? Crazy.
Let's get nuts!
Get nuts indeed. Thanks, Corey. Appreciate it, man. You for your generosity. Hitting up the Twitter and the YouTubes.
Stacks up, one versus the rest. Why does one stand out?
Well, right now it's an interesting time in the home building market because it doesn't seem the stock market is giving the builders much credit for everything they've been through in the last 3 or 4 years. You know, we've gone through a pandemic, we've gone through supply chain shortages, we've gone through massive inflation, we've gone through unprecedented rate increases that hadn't been seen in over 40 years.
Pocket Kings.
And yet the builders are sitting here trading near 1 times book value.
Had to call any on.
Essentially at 1 times book value. You would think after everything they've been through, and the
you got lucky with that. If you actually saw it, you might not have called that.
Maybe people would be more interested, but it seems that the uncertainty is going to remain with us until the Fed announces that they're done. Hopefully that's today. Or hopefully by the end of the year.
What are the expectations?
But as Jay said, you know, there's a lot of good things going on for KB. They're focused on the right.
We'll follow expectations.
They're in the right geographies. And so
that's
we
my
think
prediction.
it's an attractive stock to be involved in
Fed
at
funds
this point.
futures
Even
say
if they missed by a penny or two, we think in the bigger scheme of things, that's not a big deal.
Right, understood. I mean, we heard from Lennar last week, Jay, and you said, I was looking through the notes of both of you, but we've seen a theme where home builders are having a hard time finding land, but then they're building. Some of the specs, the way they're doing it, cause cancellations or they have to pause because of rising costs. Jay, we did hear from Lennar last week. Any takeaways there in this higher rate environment, too?
Yeah, I think what we heard from Lennar is that they are still finding the demand. They may have to be moving price around a little bit, doing some mortgage rate buy downs. But we're certainly, to this point, haven't seen the cancellations in the back half of this year like we saw in the second half of 22. So the demand's out there. The builders are finding ways to get the customers financed. I think the other thing that we heard from Lennar is that cycle times, which is the time from when you start the home to when you actually close it, those continue to come down as the supply chain gets better. So, you know, it's kind of in terms of like things around the periphery. That's what we're expecting to hear from KB tonight, that they're getting homes completed faster and that via buy downs and or incentives, they're finding ways to still make these homes affordable and help offset some of this move we've seen in rates.
Building permits versus housing starts. I mean, you see the applications for the permits. I mean, they're there. I mean, this sector has gone to 52-week highs. Really, you know, really undoing what everybody thought housing would do. Surprising, folks. Alex, final thoughts.
Well, you know, housing went through a severe correction on the back half of last year, so it's not surprising that the stocks have done well this year. The consumer started to come back in January and has continued to hang in there.
What in the world?
The builders have been very smart in offering rate buy.
Guys are river crazy.
Down to 5.5%.
They have to see the river.
Public builders builders continue to gain market share. And we think, as we said,
One lane to
that,
5.
the outlook is pretty bright for the builders
I thought
over
about
the next few
bluffing.
years as they continue to gain market share at the expense of private builders and as they have a better value proposition than existing homes.
I got a call.
Yeah, and the concern is that you could see a
Pocket
decline in this area. You
threes?
even talked about maybe missing by a few pennies, but still liking it. Jay, what are the names you have buys on these days?
So the names that we like, KB Home, we also Century Communities were buy
Pump
rated
today.
there.
We'll get a pump.
As well as
Probably get a dump too.
MTH is the ticker on that one. Those are three.
But
of
yeah,
the
your
entry-level
expectations.
focus names that we're
We rally from
talking
here.
about these days.
So pause.
Great to see you both. Thank you.
You're maybe even thinking of cut,
Jay
huh?
McCandless and Alex Barron. Good luck there.
Man, that hand sucked.
Housing overall. Appreciate
Should
it.
just folded.
That's going to do it for us here on Trading 360. I'm Nicole Petalides. Thanks for being with me every single weekday, 11 a.m. and 2 p.m. right here on Schwab Network. I'll see you later at 2. Of course, it's Fed Day. We'll have a special edition of our show.
All right, coming up on 12 o'clock. A raise. You might have a queen. Another queen. Interesting. No spades. Lost my spades. Damn, getting unlucky. Well, big hands there that pockets, giving full houses. Have it. Oh, he's bluffing. I might have it. Pretty small raise. What? The 10s took it down? Oh my. Plus that guy gets through. Black climbing back up to VWAP here. GNS up 18%. Bouncing back to VWAP. GME up 1%. AMC up 2.8. All is quiet on the Western front. Saw a pretty good movie the other day. Netflix movie. Million Miles Away with Michael Pena. It's a good movie. True story. Buy rejecting VWAP. Jeez. Missing spades, higher pair. I don't believe him. Add to list. Yeah, that's good. Oh, liquor's waking up a little bit. 6.8%. Build-A-Bear. Can't stop, won't stop. Build-A-Bear. An aggressive raise. Ooh. Hopefully someone has a king. Hopefully some aces out there. Nice, nice, nice. 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 I might just check this one. If there's an ace, that'll re-raise. No takers? Just kings. I think I'm bluffing. Come on, bluff catchers. Ah. I don't know how I could play that different. I could have raised more before the river. Or raised in general. I thought they would probably try and re-raise. Well. Oh. Spades got, or diamonds got there. AMC moving up a little bit. It's up 4% now. One more diamond, I guess. Bugger. Got a call. Queen Jack. And the Queen. Yep. $12. Light raise there. I have cash. I'd pair the crappy kicker. Guy likes to bluff. Yeah. I'm making an inverse head and shoulders, but doesn't matter a whole lot before FOMC. Might get a rally back up to open though. I could see that. High of the day. Not open, but high of the day. Six ace? What? Dude was bluffing. Oh my gosh. What did this guy have? Pocket something, I think. $900K. I called. I love it. We'll get lucky like he does. Oh, he had a 5. I can't believe we called that with a 5.
In rates, that has shifted back up a bit, right? So you think we're at 5, 5.25 right now. We're only expecting a 75 basis point decrease over the next 18 months, basically. This is a big market sentiment change. And it's not like it's just popped today, but I think that's a really, really interesting thing. And I think that's going to be the most important out of this meeting, is to get a sense from the dots, to get a sense from the commentary where this thing is going over the next year. Because it was you remember this? It was a foregone conclusion that rates were going to be down to nothing again, like by middle of next year.
You can make a
and
case
it was going to be
still that.
they were going to be cutting, and they were going to be cut, right? And it's a little bit lower, but I think the sentiment's changed a lot, and you're seeing that priced in out of the futures.
Dude,
and
there's just straight out there, isn't there?
There's just not a sense that we have any clear path of this thing actually going lower. So it's like the base case went from they're going to take them right back down because
Kings. These guys folded.
Control to inflation's a bit stickier. Rates are going to be kind of flatline for a lot longer, and you go out, again over a year, and it's assumed to be a lot higher, and that's just it's fun. I got a big smile on my face. It's fun to see the market adapt.
I've got a big smile on my
winning.
face because the Fed's been wrong about, they were too late to the game as far as raising interest rates.
Disagree.
They were too late. That's why inflation.
This is why I bring this type of stuff up. They were wrong.
This poor guy with his pocket kings, he should have won that.
The market's been wrong.
Not their fault.
That river, he should have been more aggressive, maybe.
Because they expected rate cuts by the end of this year.
It's fun having pockets and not raising pre-flop.
So a lot of people have been wrong in the room.
The market, I agree, has been wrong.
Yeah.
But you can make the case the Fed can't start raising rates during a pandemic.
We were out of the pandemic.
You were not out of the pandemic yet.
They were about 4 months, 5 months late.
It was very close, right. And you can't blame, poor Jerome Powell gets hammered about this transitory tone. When once he said transitory, if they didn't spend another $4-point-some trillion, maybe it would have been transitory.
Yeah. Oh, well, Kevin, here, let's get something straight here. I'm not bashing against Jerome Powell. Because they
will make him the scapegoat.
Well, they have to.
Right.
Because they always do. It's just like the head coach. Even those players play bad, he's going to get the rap. But think about this, is the fact that he's working against an administration that's working against him.
Yeah.
So
yes, they're working against each other.
Been, he's handled it well. Sometimes I bash against some of the decisions that they made and the duration or time frame that they did them in. So I have that right, and I think a lot of people would probably agree with me on that. But at the same time, they're working against forces that they didn't cause. So it's been a tough job for Jerome Powell, and I think him navigating this discussion today, Nick, is going to be really important. I think for markets.
Well, and you guys touched on it earlier, but I think I love this day. It's so exciting. It's like
if you're a geek,
there's no NFL games on Wednesdays. It's the perfect day. It bridges to Thursday night football. This is great. So if you $90 a barrel oil, right, and higher than that yesterday, right?
Yeah.
100 is like you can easily see 100 on the. I don't even think you have to go to the horizon to see $100 barrel of oil.
Yeah, Goldman came out and said they could see $100 a barrel oil.
Yeah, they said 12 months though.
Yeah,
come on.
exactly.
You can make a case. You can make a case for another 10% higher in oil by the end of the year, and I think gas as well. Like what's going, the war in Ukraine is quietly ramping back up, right? With the drone attacks and like. If Putin doesn't like what he sees, how quickly is that going to happen? So what's that going to do to gas prices?
What if it's a cold winter?
What if it's a cold winter?
Yeah.
Like all of that, you're like, oh, inflation is under control now. We're going to lower rates, and then the VIX is like 13. Who cares? Right? So none of it doesn't quite add up. And I think when some of the uncertainty comes out today, you would expect. The VIX to come in a little bit. Typically, when the Fed announces and we get the dots, it's not every meeting, you see a little bit of
AMC,
a lag effect. It takes the market a while to digest that. So I would expect there's going to be some movement today, but we're probably going to see some decent intraday vol tomorrow based on
probably has
what
like
he says today. It's
2.5.
Sort of how these days tend to go because it's not
2.10.
algos can't digest all of what he says in a day, right? You have to position around that. So I think VIX is probably understating a little bit, if not
Unsuited.
a lot, what's really going on here. And then you've got this, this sort of quiet as well, government shutdown pending and no real path forward on government spending.
Oh,
so,
you got wrecked.
Loans have to get
what?
Repayments kicked back, and none of this
How
is
did he
like
not get it with the
glide
kicker?
path to zero interest rates anytime soon. I think that's how are they going to navigate that?
One thing, we sat on this show and talked
You're
about
welcome for bloating up the pot
debt,
for you.
and there was basically a zero chance of that happening. Shutting down the government, that's a whole different story.
Right.
There's a very high probability they're going to shut down the government.
And that's not typically a huge market driver.
Effect.
It's not the same effect.
Not the same effect.
Because everybody looks ahead to when it goes away. Everybody looks ahead.
And no one misses a paycheck. They do, and then they get it made up. And it's actually right. It's not the same event that potentially, though they've never done it, defaulting on the debt, but the government probably will shut down, actually.
And we'll be talking about it on the network.
Ad nauseum.
Quick question, Ken. And I think this is important for people that are going to watch, the announcement and then the commentary. We'll have all that here on the network. Tune in for that. We'll have part of the press conference also. But should investors be watching equities or the bond market after this announcement? Because 10-year yield hit 16-year highs yesterday, coming off a little bit.
There's a straight there now.
A little bit in bid in bonds, yields pulling back just ever so slightly.
Check it down.
I think you should focus on
the bond market at this during the commentary.
Here's the good news. With the Thinkorswim platform,
I'm
and
gonna do
your
all these
watch
hero
list, you can
folds. It
rock
sucks.
both.
Oh my gosh, I didn't call it.
So we don't have to, it's not a binary choice what you watch here, but you're right. You should be watching.
Oh my
yields,
gosh,
you
third
should be
pocket in a
watching the
row.
dollar, and you should be watching
Stupid pockets
equity
though.
markets.
Right. Yeah. And Nick, we had some gyrations during the last meeting. Dot plots are going to be in focus again today. Last time they came out was in June. They're expected to tighten up the range that they have from members, but we've heard some dovish commentary lately. Nick, real quick, give me just your take on that, where maybe this is the last hike we're going to see.
You know, it could be, right? It could be. I think if you get one more and then we stay on the path that we're on with inflation, I think there's a pretty good case for that, because it's not like they're reversing it, right? We're remaining restrictive. I wouldn't be surprised though with the upticks in some of the areas we've seen, some of the areas in CPI, some of the PCE data to show they're going to be consistent in doing what they say they're going to do, and that would be another raise of a quarter probably. Next
Jerome
meeting.
Powell have to say, well, we look at the core.
Yeah.
Right? Because they're going to ask him, well, what about crude oil? What about the headline numbers?
Yeah, and
but you
if
can't
crude oil
ignore
stays at $90 a barrel,
right?
It's an
it's going
input
to have
to
some
so many
impact.
things. You got the auto workers strike coming out.
Yeah.
He's going to have to address this stuff, because whether you like it or not, those are actual inflationary drivers for real people.
Yep. Yep. We're going to focus on that all afternoon here on the network. But let's take a quick break. When we come back, we're going to take a look at an earnings event. That's FedEx after the close. The delivery giants rallied sharply so far this year, and we're going to focus on them cutting costs and maybe that yellow bankruptcy, what that did to their balance sheet. Coming right back.
New high of the day there on AMC, up 4.75.
how good is that cost-cutting effort going in the face of lower revenues, and what are their revenue outlooks for the rest of the year, I think are going to matter a lot.
Yeah, macro backdrop is going to be important for this company moving forward into their biggest season, holiday shopping season here.
Yep. I mean, I think you have a big iPhone cycle, right? There's a lot of change there. I mean, I was just looking. One of the leading indicators is how far backlogged is it now, and they're already a month and a half out in terms of iPhone delivery, right? They're a huge player there. So is UPS, right? They use all the services, but so it seems like there's decent uptake, but we know that people are pulling back because of higher costs, right? So what does that look like versus how bring my butterflies, because Kev likes to make fun of me, but
you're such an OEX trader.
A little unbalanced butterfly.
Like it into butterflies.
Very easy to talk about even math on this. You've got a 255.65 call spread, so you're long a $10 call spread. And then you've got the 265.70 call spread as part of that butterfly, so a $5 short spread, about $2.50. So you're paying half of the strike width versus you've got a $10 strike, so you're paying only 25% of that. So it's kind of a neat breakdown. I like the chart, very even round numbers to look at, all that fun stuff. So your max loss is what you're paying. That's the $250. Your max gain on that is the inverse of that on the $10 wide spread, or $750. There's no risk to the upside here because the long spread is bigger than the short spread, right? So you have this embedded short spread, but it's a smaller width between the strikes. So the risk profile is nice and kind of clean to look at there. You have no risk to the upside and just the 250 on the downside. As always, when we talk about these things, what I've done is put the midpoint of that spread, the 265 strike, just a little bit inside of the expected move of about $14. So, it's looking for a little bit of underperformance. The likelihood of earnings coming out, the world pausing and pinning your strike is almost zero, right? You don't pin the middle strike on this, but you're using the expected move to try to get close to that, to be able to then manage this trade with only a day, of 2 days left of trading after the earnings announcement comes out.
Yep, let's break this one down. Really short-term positioning here as an example. September 22nd weekly series expires in just 2 days. Buying one of the 255 calls, selling two of the 265 strike calls, buying one of the 270 strike calls, so an unbalanced or broken wing butterfly. On the call side, you're paying roughly about a 250 debit on that. There's your risk, $250 with that break even at 257.5. As Nick mentioned, the apex of profitability at or near that 265 short strike that you've got two contracts on. But even, Kevin, if you go above 270, it's going to be a double as far as profitability goes. So it's a directional play, but you're offsetting some of the costs. Give me your take here on the unbalanced call butterfly.
$10 long spread versus a $5 short spread means there's upside. This is a butterfly that won't go all the way back down to zero if it goes to the upside. The risk is to the downside, just under 9 deltas. You're actually paying theta. Why? Because all your options are out of the money. Right. If it goes into that range between 255 and 265, that theta number will go from negative to positive as you move in there. But this is a bullish play. If you are not bullish on FedEx, this is not the play for you. Remember that. So the risk is only what you pay
There's an ace, right?
That's the great thing about this.
Straight out there
and
also.
Like I said,
or a flush, rather.
You have
flush.
Profits on the upside no matter how high it goes because $10 versus $5.
Yeah, I like that lesson in there. As you get closer to the short strikes is when you'll get that positive theta or time decay.
It'll switch from negative to positive.
Yep, but definitely a bullish example here. If you think this stock's going to rally, really short-term positioning here. Only a couple days until expiration on this one. But good look at that unbalanced call butterfly. And thanks to Nick Theodorakis for joining us. But coming up after the break, Kevin and I are going to be joined by Landon Swan from Like Folio.
See if a slow play will work. Probably not.
Restaurants and the data on the stock moves. Stocks pulled back since hitting those all-time highs at the end of July. They report earnings in the morning. Coming right back.
They all folded? What? Buy above VWAP there. Yeah, little rally on SPY. I think we'll still get the pre-FOMC pump. Test the high of the day still. What are these guys raising on? Oh, the tens. Still down the session. You bought in 2 times, maybe 3 times. Guess the diamonds got their pair.
Three, I think, are going to be the key ones to watch for over the next little bit for this company. But Olive Garden does make up a very large percentage of their revenue, so it's good to see that they're growing. And you know, when you compare them across their competitors,
is it lagging again?
You know, look at EAT and Cake at Cheesecake Factory and Chili's, and you look at the happiness on those, and actually that's a little bit of a concern. So we've got Darden restaurants at the lowest of the happiness here. Now it's not a huge spread, 67 to 74. The size of the bars may, you know, make you think it's a much bigger spread than it is, but still 7 points is worth noting. So it's a little bit of a concern there, but we still have, if you look at, you know, inside of the inside of the brand itself, it's actually Olive Garden is probably the one that's bringing that down. They're only 63% happiness, but some of the more fine dining stuff like Capital Grille is up like 83%. So, you know, it just depends on which brand you look at. And it's tough to compare to just one, just a restaurant or a company that just has mostly one restaurant like Cheesecake. Is the web business.
Slow played him.
Obviously, the web
I didn't even see this trade out there.
As critical for a restaurant.
What
you
the
know,
heck?
It's bigger for more
Slow played
retailers.
him heavy with
like
that little
but
min
you
bet.
can still get a sense when people visit the website, they're thinking about eating there. Maybe they're thinking about placing a ticket order or something like that. We do have them at plus 10% on a year-over-year basis. So seeing a little bit of, I guess, unexpected strength from summer to summer, or as we, you know, end out the summer here in September, a little bit of plus 10% on a year-over-year basis. So overall, you know, with the pullback in the stock and just the relative strength of the web visits, plus the fact that they're big brands, you know, the ones that are really important, are actually doing fairly well, and I think they're onboarding Ruth's Chris fairly well based on our data. I'd say that we're leaning a little bit bullish. I mean, if this stock was still trading at the low 170s, or if it was making new highs at 180, I'd be a little more hesitant. But the pullback, I think, gives us a little bit of an opportunity to be contrarian and say, you know what, I think that this company was more fairly priced at 165 or 170, somewhere in there. So 150 can feel like a bargain. So we've got a very slight bullish lean on Darden going into this earnings report.
Landon, though it's not surprising, their cost of labor is still slightly higher and going up.
Gosh.
Their cost of goods sold is all coming down. A bunch of their expenses seem to be coming down, which should be adding to their profit margins. They're supposed to jump up here as, like I said, some of their expenses start to come down. But do you have any data to explain why this stock sold off as hard as it did? Because you're right, this 150 level from a technical perspective is pretty solid level from a long ago resistance. Now it looks like it's support, but boy, this needs some good data here, Landon, because this stock has sold off hard.
It has. And, you know, we've actually had a bearish alert on this company for a little while now. So, you know, we like to see that pullback, and it, you know, some of the data that we had was fairly bearish on it, but now a lot of that is kind of turning the corner and getting more into the bullish mark. So we haven't officially taken off the call, but, you know, we're kind of warning our clients that we do expect a decent report here. So maybe, you know, buy some calls if they've sold short, something like that. But at this level, it's, you know, from a technical standpoint, you either break it here or you're bouncing off of it, most likely on an earnings report. And our data is, again, it's been bearish, but now it's turned the corner to slightly bullish, mostly led by Olive Garden and Longhorn. And so those two companies doing pretty well, or those two brands doing pretty well. Ruth's Chris, again, the onboarding there seems to be doing pretty well. Some of their other, you know, fine dining is not doing as well. We do have data that shows that people are, you know, quote, trading down. So instead of, you know, spending a lot more money at Eddie V's, they're saying, you know what, let's just go to Longhorn and save some money. It's still just as nice, good experience, whatever. They're saving some money, basically. Not saying that with Ruth's Chris. So that's kind of the one that's bucking that trend. So between those three, I think that's what's causing us to lean a little bit bullish. And if you guys know our scoring, if you get to 20, that's where we're bullish. We're at plus 21 on Darden going into this, so just barely over the mark. Good enough to make a bet, I think, at the 150 level here. But again, if it gets 165 or so, then I think that's good enough for me. I wouldn't go above that.
Landon, when you guys look at your data, especially, you know, I kind of want to throw in the crude oil debate here, where you got crude oil at 90 bucks a barrel, continuing to move higher. Does that really play into data when you guys look at some of the metrics where, hey, oil prices are up, what, 17% over the last couple months here? That means driving somewhere, I'm going to have less money in my pocket. If you have $100 at the beginning of the month and you can spend 30 on gas, now it's 45, 50 bucks. I mean, do you have data that kind of has, you know, a little bit of inkling into maybe consumer spending? Because I think that's going to be the key, is the macro backdrop of the consumer going into the holiday shopping season.
Yeah, I think it's a good point. And, you know, we've actually looked into that somewhat and just dove in to see, does that affect people? And from what we've seen when it comes to gas prices, the biggest thing that affects is the road trip vacation. People aren't really talking about not doing things local because gas prices are high. I think they just kind of bake that in. They don't really think about gas prices as a function of doing something until it's very, very closely tied, like we're going to drive 500 miles down to the beach or whatever it might be. Maybe we shouldn't do that. Maybe we'll stay home on a vacation. But as far as like going down to the local restaurant, supermarket, or whatever, they do complain at the bill when they at the pump, but they don't think about not taking that trip. It's just kind of cost of living. So I don't think it's a big impact. It probably has more impact on you know, the cost of goods sold.
Wondered if you had that too.
But those are going down, putting Darden in a good spot to have higher margins with menu prices higher, but food prices possibly dropping.
Yeah, we'll have to wait and see. Yeah, the pullback's probably given some opportunities to people that are bullish on this name, but you know, I'm curious about the consumer, because going out to dinner, going out to a meal, is a treat that maybe people start giving up first. I don't know.
Yeah, but maybe the evolution is you don't go to Ruth's Chris, you go to Olive Garden or Longhorn, and maybe it's that trade down that we talk about in retail all the time.
Yeah.
Yep, that's it. You trade down, and next stop is fast casual, and then after that, you're cooking at home, or maybe fast food in between. So
Capital Grill.
There's a few steps where Darden's still in the sweet spot.
Yeah. I want a Stoli Doli right now. So
still Capital Grill, Stoli Doli.
All right, thanks, Landon. Appreciate it. Have a good day.
Good call on that right
Thanks,
there.
Guys.
All right, that's Landon Swan, co-founder at Likefolio, breaking down the data for us on Darden on this pullback. So, Kev, we got a complex trade, so I'm going to let you walk through here as an example here in Darden Restaurants.
So, if you want to do something for an earnings play, right? But we promote using options a lot on this show, right? Frequently. But what happens if you want to use options, Tom, but you also want to skew them, but you also notice there's a 3.5% dividend on Darden Restaurants that, if my calculation is correct, it's coming out in early October. So it's not far away from a dividend.
I climbed up a little more.
Is I constructed something in the butterfly family, but my long option, I'm replacing it with the actual underlying. So what I did was, Tom, in 2 trades, I did a covered call. Then I took that covered call and I made that the short strike in a short call vertical. Okay. So it creates like a hybrid butterfly, right? I'm long the stock, short 2 of the October 160 calls, and then long 1
Played obvious.
of the October 165 calls. So you do have something in the butterfly family where you have that peak, but you also have a covered call strategy, so you do have more risk on the downside. So it's a different animal, but it's something that's collecting theta and in the butterfly family.
Oh, jeez.
Long 1 underlying, short 2
called?
long 1.
Yep.
Do you have pocket ace,
this,
pocket kings?
I think this is an important lesson when breaking down these complex trades, because on the platform you've got to put it in as 2 separate trades here. So the way that we looked at it was buy 100 shares of stock.
Do it.
We've got here you're paying around 51.
Oh my gosh, what do they have?
130 on that, but it's a lot less. It's about 150.20 right now. But if you're buying 100 shares of stock,
I'd love just playing it obvious.
Just
totally open face.
Risk using this example.
Oh,
and against that, you're selling a 2x1
they just think,
ratio.
no way, this guy's bluffing.
Custom call vertical where you're selling
Don't
2
need a
of the
slow play.
160 strike calls, buying 1
looking
of
at
the
puts now.
165 strike call.
Being patient.
You're collecting roughly
High day, I'll probably pick up 1.
credit. It's a little bit less, just
If
like
we
the
get
price
there.
of the stock is at this point. But if you look here on the risk profile,
I'd like to have at least
100
1
shares of
before
stock,
FOMC,
short
before
2 of
2
the 160 calls
o'clock.
in October, buying 1 and long 1 of the 165 strike calls on that. Now, you've got risk on owning the shares, as Kevin mentioned, break even just below 150 on here. So you've got that risk all the way down to 0 if for some reason the stock went down to 0, Kevin. But when you look at this, you still got some risk on the 1x2 call vertical, but that'll be offset if you start getting hurt on that to the upside.
And the question that some of our viewers might have is, how do you put this on, right? How do you get this on? Well,
exactly.
You could do
I guess I can just call here. Let's go. Pocket aces? Shut up.
Two individual trades that'll get you to this.
No
because
freaking
a
way.
package like this may be more
Straight gets
difficult
there.
to fill. But as long as, like I said, do a covered call strategy and then do a short call vertical. 2 trades make up 1 complex trade.
Yep. Yeah. Either way, you can do that if you just buy the 100 shares of stock and sell a 2x1, or, as Kevin mentioned, just do the cover call and then sell an additional call vertical on the 160, 165 line also on that.
I got my money back
trade.
and then some.
Anything even above 165, Kevin, is still going to be profitability on that because you are long the shares of stock, even though you're short 2 of the 160 strike calls. All right. Good look at that complex trade, but coming up after the break, we're going to take a look at KB Home. The home builder stock has been under pressure over the last couple of months, but new home sales data has been pretty robust recently despite those higher mortgage rates. Fast Market's coming right back.
You have an ace? Pocket nines. Trying to bluff him with the potential for that straight. I forget I need to play this little different than cash games. Jeez, I'll just check it down. 6 king, dang it. Don't have an ace. Oh my gosh, with the 5s. Thought my 7 kicker. Bump it up. We'll get there. We've got, let's see, it's 12:45. Less than an hour. Or no, over an hour. What? No. Going for that high card. Ooh. Low played that ace. Game. Too early to be muscling him. Lines are too small. So he's muscling me? Okay. Oh, he called. Oh my gosh. He called the ace flop or the ace turn. I gotta see what he has. I don't need to. I don't think he has that 7 though. That was crazy. Crazy hand. Keeps calling. Good player. He might be better than me. Look at those cards. King, Jack of Hearts, Jack, King of Hearts, both suited, both back-to-back hands. Six, nine. Well, you want to call my bluff. Can't blame him.
But at the same time, we know that there's still a housing shortage. Prices remain firm. But I think the 7% range in interest rates, at least for a 3-year fixed rate, is something that a lot of people become very wary of. It used to be 6% or even 5%, if you can believe that. But I think 7% seems to be an area where people get cold feet.
George, why do you think, in your opinion, that this stock is so inexpensive from a price-earnings ratio, from a price-to-book ratio? It trades below 1, George, which means the price trades less than the value of the company if you broke it up and sold it. Why do you think that is? It's just, you're right, the comps from a year ago look horrible. They're expecting $1.43 versus $2.86 a year ago. Revenue $1.48 versus $1.84 a year ago. Is that why? Is it just are the comps just dragging on this?
So yeah, the thing is when you look at the cyclicality, I mean, we went through a situation where obviously there wasn't homes being constructed to the point where they're now not able to keep up with demand. There's so much cyclical variability on the annual earnings and revenues for the company. I think what we're actually seeing is some of these metrics, at least from a price to book, price to sales, and even you can make the case from a multiple on a forward basis around 7.5 times earnings cheap.
Gotta have an ace, right?
It has to do with the fact that we're seeing normalization. If you look at the forward sales for KBH, they're more normal at around 4.5 to 5%, but the earnings growth for the next year is only expected to be around 1.5%. So I think the growth trajectory in the next 4 quarters for both earnings and sales are normalizing, and that's why we're seeing more normalized valuations being established here for the company. And again, the comps are compared to the banner 2022 year. So even though it looks bad on paper, down 49% earnings estimates and sales, the stock price is still holding up quite well because of the fact that there's good value still in this name.
Yeah, it's almost like if you look at names like in the home builders, and you mentioned the valuation, it's like banks, right? That price to book is always at low levels. So I think it might be sector specific.
If you're a value investor, though, if that's what you look at, I mean, boy, these numbers are low.
They always talk about the volatility within that and the seasonality within a lot of these sectors also. All right, thanks to George Tillis, senior markets correspondent here, breaking down KB Home for us. Kev, example trade time here in KB Home. So I looked at something that takes advantage of the higher implied volatility. Looking at a different strategy, we sometimes talk about double diagonals, but this is a specific kind of double diagonal that I brought here today, and it's a straddle swap here. So I'll break down the example trade out in the September 29th weekly cycle. So 9 days from expiration, I'm going to buy a strangle. So I looked at buying the 53 strike call and the 47 strike put. So there's your buying your out of the money call, buying your out of the money put, 9 days till expiration. And then to offset some of those costs, I'm going to sell something near term. It's a neutral type strategy where I'm going to sell the September 22nd weeklies that expires 2 days, sell the 50 call and the 50 put. So I'm selling a straddle in the near term options that have the higher implied volatility, right? So you're taking advantage of the divergence between implied volatilities. So you're buying a strangle in the September 29th weekly series, selling a straddle in the near term September 22nd on the 50 strike. You're collecting a credit of about $1.70 on this one, Kev. It takes your break evens to about 46.5 on the downside, about 53.85 on the upside. But this has got that component where I've still got a week in this trade, Kevin, where I have that potential to maybe roll that short 50 straddle to the next cycle. But It's definitely
Coming up on 1 o'clock.
A neutral type strategy.
Maybe going to make its way up. Did make this inverse head and shoulders this morning.
Here on the strangle straddle swap, which is also called in the double diagonal family.
Exactly. It's in the double diagonal family because you're short a call diagonal, short a
Guys,
put
not gonna
diagonal.
push me out.
It does give you long
See,
beta
man.
though, because it's in the calendar spread family.
What?
So, but yeah, you want, just like a peak, just like anything you'd see, you want it as close to $50 as possible.
79526.
Really
No.
position example that we're looking
No.
at. But if you think this stock's going to stick around that $50 level for the next week and a half, this might be a strategy that may be profitable on this. You do have some assignment risk on those short options going into expiration, either on the upside
6%.
or downside, because you're short the 50 call and 50 put in the near term options.
2,000% to go.
Good look at that example trade. That's going to do it for Kevin and I today here on Fast Market. Now right here on the Schwab Network, Next Gen Investing is coming up.
Next Gen I. Come on, Juan. He's calling these? Do it. If I did it on the turn, he probably would have folded. Got there with a pair of twos. What the heck? Whoa. Climbing up a little more. GME's green 1.3.
was that Jerome Powell said in his press conference. But a lot of hype into these events, and then it seems like as of late they've disappointed. But we'll obviously be discussing that more later on. We'll kick things off here with our upvote and downvote segment, and we'll chart and trade those upvotes. And our FOMO discussion today is Pinterest moving to the upside after its first analyst day, actually, since going public back in 2019. Then we will look at Cody with some revised guidance to the upside, also seeing a nice move higher today. And last but not least, we will revisit all things Fed with George Tillis to recap sort of the expectations into that event.
If anybody can get me excited about the Fed, it's George Tillis. I'm looking forward to that. But you know what you don't need to convince me to get excited about is Pinterest. I love talking Pinterest. For a site I've never even really been on, I don't think there's a stock I like to talk about more. So I'm looking forward to FOMO, no doubt. And then upvote, downvote, very retail dominated, but all different types of retail. You got the Amazons, the Walmarts, Dollar General, Chewy. We have so much to get through. I'm excited to go through them. So let's kick it off there. Not endorsements, not recommendations. With the company I know all too well, in Chewy.
And Chewy touching 52-week lows earlier in today's session. It's since recovered slightly, but this name has seen so much weakness, down around 50% this year. We also got some more pessimism out of the analyst community today. Oppenheimer downgrading shares to perform from outperform with no price target. The analyst expects a more challenging backdrop for Chewy to persist for at least a few more quarters amid recent signs of weakness in historically resilient pet food categories and the potential for more muted inflation benefits in fiscal 2024. In addition, they did note the current higher interest rate backdrop represents another pressure point for shares here that have already seen their good degree of pressure over the last several months. But the firm has a favorable view of Chewy's long-term prospects, they noted, but awaits definitive signs of progress on net additions and a potential reset of some of these overall street numbers. And I think a reset is what a lot of investors are hoping for here with Chewy shares. This name does skew still to the upside. I mean, 16 buys
walked into that one. Pocket aces, wow.
Which does
the straight came out. So lucky.
And you know what's wild is that $37 would have
so
been below
lucky.
The current share price just back in July. It shows how far this stock has fallen in very, very short order.
Wow.
We're on lifetime lows in this stock. We have never
Worst
basically
case
traded
scenario.
lower than this. The all-time low is 1846. I know it's 1870.
I guess it could have gotten a full house. That would have been worse.
That was just made. So you're talking about a stock that has never really been lower than now, and the market's not struggling. So that's worrisome, but you start thinking about what the analysts are saying, what investors are thinking. You know, they might have higher price targets and buy ratings just solely because the stock's on its lows. It's not necessarily because there's confidence in what's going on in Chewy. We talk about it a lot. They do a lot of things well, but it's a niche industry, and it's one that maybe seen better days a few years ago when everyone was at home and spending all the time with their brand new pets.
And facing more competition from some of these major retail players, like our next name today, which is Walmart, which did announce they're opening a dedicated pet service center in Dallas, Georgia. That's about 30 miles outside of Atlanta. With the move, the nation's biggest grocer, which is Walmart, of course, is building on its traditional pet business. But with this new facility, Walmart said in their press release, a more lucrative part of the pet industry, which is healthcare and all things pet pharmacy. Walmart's Pet Services Center will have its own dedicated entrance next to the store. It will be carrying this Walmart name, but employees of vet care and pet product company PetIQ will staff it. PetIQ has already rented the space for vet clinics inside more than 65 Walmarts. That relationship has already been established, has been ongoing since about 2016. But this Georgia location will serve as a pilot. Walmart does plan to open more locations per this announcement. They did not disclose a timeline on when they expect to unveil more of these locations, but at least trying it out here. And the VP of Merchandising for Pets did say this is an important need for their customers. They want to be able to provide all of their services in one place. This VP did cite a Morgan Stanley study that found 40% of total pet industry revenue was driven by services, which I know that you get your dog groomed, and that's not necessarily a pharmacy service, but one that is definitely a hefty cost.
Raise. It's too fast. When did you want me to raise?
For tomorrow, actually, so that's a good reminder. I appreciate that. But you know, if Walmart does
no slow playing, you want me to raise?
This industry, it also helps get people in the
chat always wants me to raise.
So whether it is just dropping the pet off, picking it back up, and in between you find some of those extra items you need.
I think I played it right. That one time he was just barreling into that bluff.
Getting that service done. that's more reasons to be in a Walmart.
I had
That's ultimately what they would like to see as well. We know high margin when it comes to services, but this would be a key breakthrough into a pretty robust industry despite Chewy's lackluster performance. The pet industry is still
Jenna is wearing like lingerie.
For a retailer like Walmart.
Right, and I think to your point, to get more customers in the door is important. I was reading about all the different services they now offer within
back
their
to VWAP.
stores, and it's things like pharmacy, a wireless service center, eye care, and a garden center. I mean, all the photo center, the list just goes on and on. So they're becoming almost like a mini mall at this point. But our next name today falls in this retail space, although it is a discount retailer, no doubt about it. That is Dollar General. Another name touching 52-week lows in today's session. JP Morgan downgraded shares to underweight from neutral with a price target of $116.
The blinds are smaller. It's
down from 132.
kind of whatever. We'll do a whole lot of bluffing.
Core low-end consumer is already at a stress point, acting recessionary today. Compounding matters, they said Dollar General management does see excess savings for the middle income cohort on pace to be depleted by the end of fall of 2023, which we're pretty much there at this point. So they do see some potential for sequential worsenings tied to their student loan repayments, which are expected to resume. We did discuss that last week and some of the impact it'll have on discretionary names, but no doubt about it, other names like Dollar General and just retail in general, I'm sure will feel that hit. But this name does have 10 buys, 17 holds, 2 underperforms. Price target implies some upside, but I think to your point, as we were looking at Chewy, I don't think this necessarily signals a vote of confidence in the company, just perhaps that we're seeing so much weakness in Dollar General. It's down 53% this year.
Where did I lose all my chips to?
20% this month.
Oh crap, you have an 8?
Dollar Tree, which is its closest competitor, it's not necessarily like they've done outstanding. They're also down 20% this year, but not seeing the same degree of weakness that Dollar General has really felt for the last several months.
Kind of interesting too, because this is sort of supposed to be a company like Dollar General's time to shine. If it's starting to get a little bit stressful
These 10s.
on the budget,
I got the straight.
That's when you'd think these sort of core staple companies would be the outperformers. We're not seeing that at this time, but possibly do see that down the line. Very rural focused, very low income consumer focused, and if we're starting to see stress there, that is signs that there are signs that this economy is showing signs of stress, and of course that would lead to some of those not so soft landing calls, more recessionary conversations. Might be too early to know definitively one way or another, but these are becoming less and less infrequent. They're becoming more frequent analyst conversations around a weakening consumer, even though the data has suggested otherwise.
Yeah, and I think that's a really important disconnect, because we continue to get these relatively hot economic figures, and then we're seeing analysts say
GME's below VWAP.
This recession is coming and sort of gloom and doom, but obviously Dollar General has felt that doom and gloom for the better part of this year. Now, our last name is a bright spot here, and that is Amazon.
AMC still up
of these 4 retailers
2.5%.
Margin
nice
here.
raise.
I mean, shares are up 62% year to date. They're up around 70% from their 52-week low. Morgan Stanley did reiterate Amazon is overweight, maintaining it as a top pick with a $175 price target. Saying Amazon's Tuesday announcement of seasonal hires is a bullish leading indicator for expected continued retail share gains.
Your baddie ran into pocket aces against his Jacks.
Additions would be up from the 150,000 jobs added in 2021 and 25% above the previous peak of 200,000 back in 2019. This analyst does see strong retail top line driving EBIT beats ahead. And this is so interesting.
I climbed up a little bit, 10 after 1.
Macy's, who did announce some of its seasonal hirings, that it was actually
there you go. So you start doing small ins.
Where we were last year and where we were pre-pandemic, and that was something that was weighing on shares. I think going to show that Amazon is truly one of the ultimate retail killer, because they're still
as
far as demand goes. We did get a report that did reveal some U.S. retailers would hire the lowest number of seasonal workers since 2008. Planned hires so far
not going all in.
Lower than they were back in 2020.
All right, I'll check it down.
So again, Amazon completely
what were you doing?
Think that so much of our demand as consumers is perhaps shifting towards Amazon and then hurting some of these more traditional department stores.
Yeah, I mean, that is certainly one of the explanations, Jenny. You're talking about possibly a shrinking pie, but Amazon taking a bigger piece. And so this can both be good for Amazon in to some extent, but also still a negative reading.
GNS holding up above $1.
Overall retail space, some of those hiring trends. Also, could be Amazon might be a little bit over optimistic if the
Ticker
rest of the
7
companies
1/4.
are maybe more sober in
Run
their
is now green
assessments
1%.
of their situation. Amazon saying, hey, we've been very, very strong.
Etsy
We
up
continue to be
1%.
strong. Why not be prepared for a really strong season? They could be overhiring too. We don't know. And of course, maybe Amazon
Yeah,
is
down
just getting
4.3.
this giant piece of pie, and the pie's
That's
growing,
at
and
the
they're
low
just
there.
gobbling the whole thing up. A lot of explanations. It does seem, at least from the Morgan Stanley standpoint, that they expect incremental gains in market share, but they're not necessarily
Beyond is up
saying that
0.5%.
retail as a whole is going to be strong.
Nice bounce on
Yeah,
that
and
support
that's a
so
really good
far.
point. I feel like it's important to remember this narrative when we hear layoff stories. Like we got so many at the beginning of this year. Amazon was one of those that was laying off a sizable amount of its workforce, but they also hire pretty substantially. So their
Pretty good bounce on
influx of
Rome.
employees
It's only down
seems to be
1.9 now.
pretty great. But we'll move forward today with our 2 up votes. I'd say the names that pair the best together, that being Walmart as well as Amazon, some of these mega retail in the big box space, as well as Amazon just being a mega company as a whole. We'll be looking at some technicals as well as some key example trades coming up next.
Oh. Weird. That happened yesterday too. Still in VFS. Still like it for a move up. Fine. Just below VWAP now. Nice little bull flag there on the hourly on AMC. $115. Still thinking we might get a pump coming into it too. SPY came down there a little bit. Retesting that right shoulder on the inverse shoulders.
Best close recently. We did make some intraday highs a little bit beyond that. Let's
All
just
right,
call it
45 minutes.
Break beyond 165, 166, around that level there. If we do continue going upward, I put standard deviation channels on our chart to help us extrapolate where we might find some potential resistance. This goes one standard deviation.
What's up, Psych? You up?
Blue linear
Magre Mai.
line of best fit. So we have a level for a potentially extreme price right around 169. So that's our potential resistance based on this study. And that's to the upside. If we were to go to the downside, 21-day EMA near about 162.40 would be a potential stopping point that traders would have their eye on.
And it's so rare when looking at so many of the names that we discussed that 169 is a level we've never seen before. So that would be sort of uncharted territory here for Walmart, just given the fact it is at all-time highs, which feels like those names are few and far between in our coverage, Rick. But now, Alex, when trading this name, just considering the fact that we are only about $1.30 from an all-time high here, walk us through what you're seeing leaning into a more bullish example trade.
Yeah, there's a lot of reasons I think investors would be excited about Walmart's prospects, but you got to put that into context. This is a low beta name. It's a beta of under 0.5, which historically means that while it moves in the same direction generally as the market, it's obviously positively correlated to the market, it tends to move at about half the magnitude of the S&P 500 over time. It's not a high volatility stock. Another way
Okay,
to
pick
say
up another call here.
I looked at a bullish strategy, but one that would just benefit from a move to 165, 167 and a half in that range, which is very, very small.
Oh, wait.
Granted that the
I want to
stock
get
right
some
now
to
is
the
about
put side. I only have
164.5.
calls
So
right now.
that was a call diagonal. Buying the November 165 call, selling the October 167 and a half call, which, as Jenny had mentioned, would be a new all-time high in the stock if it were to get up to that level. If you look at this risk profile, though, I think this is where things get a little bit more fun. It looks like a calendar spread that's tilted on its axis. And so what we've done with this strategy is sought to remove or limit that upside risk as much as possible. In a bullish strategy, you don't necessarily want it to overshoot your target and then have risk to the upside. So with this one, it's a strategy that will benefit greatest.
Good morning,
from
man.
to 167 and
Isle of Man.
But because of how it's structured, it will still benefit.
I didn't know they spoke a different language on the Isle of Man.
So, certainly one to consider. 250 debit means that there's just
That's crazy.
250 bucks or 350 debit rather.
Thanks, Psych, you up. Is
That
that their
risk on the trade, and that's going to come down to really just
That's crazy.
do these options expire worthless? If we get through 165.
They spoke English.
In that case, then you're going to be more likely to, of course, see some value on that. But while looking at this particular strategy, Jenny, it needs upside still. And so I know it's 164 and a half, and we're looking at a strategy that has a 165 call. We're in that wheelhouse. It's Walmart. Doesn't necessarily move as much as some of the other names, but you do need that movement. You do want to see a little bit higher stock price.
Want to see shares move to another all-time high, which we know it's continued to surprise investors, at least with its relative stability, I'd say, in the overall market. Now, another name that has been relatively stable, that is Amazon, with shares up around 68, 69% here on the year. But Rick, the story is different with Amazon because, like Alex always says, this is more.
All right, for the SPY, we've got the gap fill up here. Powell could take us up there, no joke.
Highs, which is around $188 a share.
448 gap.
$51 off of that all-time.
And then we've got 440 for support down here. So upside seems like there's more.
Take a look at
break
this
that.
trend that we have. Starting around here, we've climbed up significantly
435.
from that point. We've been trending upward. Our moving averages are
I should
trending
draw on
upward.
some lines here.
But we can also see something has happened recently. We broke through this downward sloping trend line to the upside, but we topped out right around our previous highs. We didn't really make too much progress beyond that 144 level, save for one intraday or two rather closes beyond that point that faded very quickly here. Now we're finding ourselves slipping below our longer term trend line and below our 21-day exponential moving average at the same time. They were basically right on top of each other near that 130.
Could have grabbed another call.
Or so. So
planning on just trying to
a big breakdown,
kind of do it how I normally do it, but maybe just setting up a bigger string would have been better.
Here. We're seeing our moving average, our yellow 21-day start to shift from sloping upward to sloping downward here, which is an early sign of trend change. It's like kind of like a warning sign.
Cosmo Kramer's up.
Our 21-day EMA is the shortest of the 3 we follow, so it's the most responsive to changes, but it's
Chart looks nice on Cosmo, actually.
It's the one that will react the fastest, but it's more prone to fake outs, Jenny.
Okay, now I'm watching RSI again, and I can see from that red line, which is on my radar, that looks less optimistic than the red line we were just analyzing with Walmart.
Yeah,
you grab some shares of this thing.
Here. What I'm trying to highlight with this one is that we
What's the catalyst? What's all the volume?
Divergence here. We had a peak in the RSI, then we
strategic
made,
collaboration with
a bit of a
CA Papalinas Group.
New closing highs beyond our previous high price, but RSI was actually trending downward. We did not make new highs on the RSI. We also did not make our way into the overbought area, which is the 70 threshold that can be regarded as a sign of strength here. So a bit of a clue perhaps that things were not really shaping up the way bulls wanted. This is a sign that momentum, the speed of our price change, was starting to slow. Now we're finding ourselves on that 50 line, pretty much suggesting that there's not really a clear lean one way or the other. So momentum is kind of neutral to match our outlook on our chart that's a little bit uncertain right now.
Right, and this name is really attempting to sort of get into positive territory here in real time, but still down about 0.1%. Down 2% this week, though, to speak to some of that negative momentum we've seen in Amazon shares. But what price levels are you keeping on your radar here? Because this name, it always seems like there's news on Amazon, which I guess is a positive.
Yeah, so overall outlook, short-term trend is downward, but the longer-term trend is still upward here. So let's look at the upside first. Really what we'd want to break above would be this 144 level or so that I highlighted. Let's call it 145. That would be around our intraday peaks that we established here. If we do keep trending upward from that point, right around here, once again, our +1 standard deviation channel comes in just below 149, so about 148.60 or so. That could be a potential stopping point. Remember, this will kind of keep revising itself every day. It'll change every day. It's not set in stone here, but this is a guidepost to be looking at if you're
doing a little bigger tournament here.
The stock making new highs. To the downside,
and the stakes, I should have to get used to the
things to choose from between about
dollar amounts. It's
and 133. We've got our
to adjust.
63-day EMA in orange, our linear regression line, our line of best fit in blue, and the start of this gap right around here, this green dashed line on 130. So plenty to choose from there to the downside.
Yeah, and this name, like we can just see from your chart, it is all over the place. So still seeing some strength this year, but giving back some of that initial, I'd say, enthusiasm just in the last month or so, which we have seen some weakness with the overall market. But we will leave it there. Appreciate the breakdown, Rick Ducat, our chart master. So now trading this name, Alex, again, this has been an outperformer on the year. It's important to not discount that. Seeing some signs of a reversal in trend still. I mean, when you zoom out and look at a longer term picture, Amazon has been a nice performer all around. But walk us through a more bullish.
Get it, I get it. Have a queen.
And I want to mention we do have Prime Days, which is October 10th and 11th, I believe. Not really a catalyst for shares, but one that is on my radar because we have like multiple Prime events now.
I thought that was in July. I guess I'm crazy
it
now.
Happens
Maybe
again, I guess.
They got a second one. They got to keep discounting to get us to spend. But if you recall, to the Walmart trade, it was $350 in total risk. This trade's gonna be the same. I want to look.
Yeah,
at
I don't have to figure out these numbers.
It's
so different.
That are relatively in the same kind of ballpark in terms of stock price, but a very different risk profile. And so this is called a call butterfly, but we skewed it a little bit. As Kevin Hinks would say, we gave it a little bit of attitude. How we did that is we're buying a $10 wide spread, 135, 145, and we're selling the 145, 150. You recall Rick made a point to note the 145-ish zone as a key resistance level. Well, that corresponds to our peak in profitability on this risk profile at expiration. This thing can expand to as much as what you'd want to see as well. So best of both worlds. However, because this is a $10 wide debit spread, $5 wide credit spread done for less than $5 in this illustration at a 350 debit.
King, you're slow playing me?
Risk. That's theoretically,
what the heck?
I think, the key distinction with this strategy and why someone would be drawn to it this way. As you can see, if it overshoots all the way through 150, this thing will level off at $150 in theoretical max profit. No upside risk.
I picked up one put there.
And this stock can go as high
It's
as
a VWAP.
You don't have any risk to the upside.
Haven't gotten our move to the highs yet, so.
Always a draw. 138.50 is the break even. All the risk is below 135. So for a stock right now that's trading 137.50, you need about $1 of upside going out to October, which is about a month away. If you can get that, theoretically, you're at that break even. Everything else would be kind of icing on top, the cherry on top, if you will. But there is risk to the downside, and that's $350.
And of course, this is betting on the fact that maybe we'll see some interest in some of their overall early Prime Day deals. That's actually how it caught my attention, because Amazon is like my social media. I go on it.
I don't know how to play these numbers.
That'll do it.
I don't know how many blinds I have.
Coming up next, it's time for FOMO. We are looking at Pinterest, which is making a nice move higher, up about 5% on the session, following some bullish remarks at its Analyst Day. We'll discuss that more coming up next.
I'd like to get another put at some point. You play how I play the other one, just kind of chill in the beginning, or for the blinds to increase. These slow players, man. You raised again? Oh my gosh. Pocket queens, give me the ace. Yes! Straight. I got it there with a straight. Aces would work too. I'm muscling you out. How dare you put me all in? 7 jack. Well done. I'll let you check this one down. Like it. All in. Fade. Fade. I won the money. I won the money. I won. I won the money. The money is mine. All right, 130. Here we go. 20. Do it. Wow. This would be a big come up. It wasn't a nice hand. Not the greatest. I don't want to call it. Old. Had the mid pocket pair. Suits out there though. This is a big pot. Just play it slow for these beginning blinds. I think that works better. AMC bounced off VWAP. rejected that trend. Trend line's now resistance. I think I have, yeah, I have the best hand here. Not a higher flush or straight. Pair's not bad. Let's try and slow play this one. There's a full house out there. Yeah, if I started betting, I don't think I would have gotten anything. I probably shouldn't have raised there. Bald. Yeah, I'm actually not up that much. Seven, 3. Dang. Not this one. Nice. How do I fold this? Call. Wrap my head around these numbers. Yeah. Oh well. Awful hand. Eyes coming down a little more. 25 minutes. Five, queen, 3. Oh. I have to go all in. I have 6 ace. Good game. Too bad. That was a big one. It was like 40 million, I think.
That can impact the amount of time spent on something. But really, when it comes down to Pinterest, though, why would you go on Pinterest? Well, one, you're either keeping track of something like you said for yourself, or you're looking for ideas for something you want to buy. So you're already you're wanting to buy something. You're just looking for it. Pinterest helps connect you directly with that.
Back to that right shoulder level.
That particular item.
Who's on
BR?
That's why this I see BR up there.
That's why this is a company that largely has a relatively easy story to tell their shareholders. It's just about balancing the amount of people on the platform, the parts of the world that they're targeting, and then ultimately how do they translate that
Another
to
call
dollars and cents
here.
to the company. We know the story makes sense, but ultimately the execution of it's important too.
Right, because they've got to diversify. I mean, they've got to get that 17% of the platform is male. They've got to up that number, I think, to make this
Okay,
a more
bought another
attractive
call.
to advertisers.
I need to buy 2 more
given
puts.
the offerings that they could have on their platform. But lots of analyst coverage today following their investor event, when we did see some positive remarks. They did file to project this compound annual growth rate between the mid to high teens for the next 3 to 5 years. That was read as a positive. They also did announce this $1 billion buyback program. Citi today, though, upgrading shares to buy from neutral, raising its price target to $36 from $31, saying they left their analyst day incrementally confident that engagement can continue to ramp, as well as advertising innovation and its fuel funnel approach to advertising. They said it can deliver improving monetization trends and adjusted EBITDA margins that can expand going forward. D.A. Davidson was another name that did upgrade shares to buy from neutral today, with it also raising its price target to $35 from $25, saying this is really a reflection of them raising their near and long-term sales and profit forecasts. They now did also raise their long-term adjusted EBITDA margin forecast, this analyst said, so they see more of a long-term story in Pinterest, no doubt, but one that's unarguably a positive one. This name does skew actually more to the hold side than I would have guessed. It has 14 buys, 17 holds, and 1
22 minutes.
underperform. The average price target of $32, which does put it below both of these analyst price targets today, does still imply around 17% upside. But this name, I mentioned it's like sort of unproblematic. It's also performance-wise has been not necessarily stellar, but not a laggard by any means. It's up around 13% this year, off its lows by about 33%. So it's just more of the quiet, the forgotten social platform, I'd say. But still, all in all, hanging on to a 13% gain.
And from what I was seeing too, it seems that analysts left that investor day with this feeling that the company left room to surprise to the upside, but still, of course, ramped things up and presented an optimistic. So it's like a conservatively aggressive approach, as opposed to, kind of use a race analogy, exerting all of their energy at the initial stages and then having no gas left in the tank to finish the race. Mm-hmm. They have gas potentially still left in the tank, but they were somewhat strategic, didn't send a negative message either. So from a trading standpoint, I think there's a lot that's kind of spurred today to the upside. There's this FOMO feeling that the stock is really getting its legs under it, up 5% today. So I looked at a bullish strategy, Jenny, buying the October 26-29 call vertical, $1.50. So what have our sort of loose guidelines been over the years with this strategy? Well, they've been trying to find an equal risk to reward, and so we've done that here. $3 widespread, $1.50 debit means $150 in risk, $150 in reward, but also have a break even that's pretty close to the current share price. Well, if filled at $1.50, 26.29, add that $1.50 to 26, you get a break even of 27.50. The stock's 27.52. So Jenny, it kind of checks both of those. Not guarantees, you don't need those, but loose guidelines that we have to sort of get this risk profile that we talk about. Because this is a directional play. You need the stock higher for this to be profitable. And this one, of course, will seek to accomplish that. Best case scenario would be the stock above 29. Worst case scenario would be the stock below 26. But then it's done. So it goes below to 26 to 20 to 18. You're only exposed for that 150. The same to the upside, though, however. So if this stock does surge, 30, 33, 35, whatever it may be, you're limited at 29, $150 max profit.
And this follows their relatively conservative upside that they gave, really following their analyst day and what the street is reacting to. I like that the race analogy. It's a marathon for Pinterest. Doesn't seem like a sprint. I'm still absolutely mind blown that 80% of users are outside of the U.S. I just learned this is an international company to that extent, and I didn't even know it. So really interesting move today in Pinterest, but we will leave it there. Now coming up next, we will look at another name that's making a 5% move higher on the session. That is Coty. After raising its 2024 guidance, we'll discuss that move with Renita Young coming up next.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Every morning, our analysis is your blueprint for the day. Bonds, stocks, across all asset classes on Morning Trade Live on the Schwab Network. Weekdays at 9 a.m. Eastern.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Power your portfolio with the Schwab Network. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. Alex Coffey joined by Jenny Horn as we discuss Coty, the one of the leading makers of fragrances, beauty, skin, and body care products for both men and women. Joining us now to tell us a little bit more about this company and why it's on her mind is Renita Young, Senior Markets Correspondent for the Schwab Network. Coty, this is a name that we've certainly talked about several times. We were just talking a little bit on the break. Not really my realm, the fragrances, skincare and stuff, but maybe you guys can help me out.
You know what, I've definitely owned some of the brands that are licensed under Coty, right? But today, the shares are up because the company actually boosted its fiscal year 2024 guidance. That's a really
I bought another call there.
Situation for the company because it's
It wants to fill that gap.
A good run when it comes
Got 15 minutes.
Right now,
Hopefully get a pump. I need to get some puts.
The Burberry Goddess perfume, along with
I'm gonna use about half my buying power into two, then try and save the rest for Powell and the rest of the day. It'll be tough though. Hopefully we're up enough on the strangle.
Of up to 12% at the high end.
Viability of bullish news. I don't know what it's.
10%. And that's not all. Coty's been
I don't know what the news is. I don't know
fragrances
anything
are
about
among
it. The
top 5
biotech.
of the fall. And then now they
Bioware.
have 3 fragrance lines in the U.S. top 10. That's pretty big. But Coty is not smelling itself too much right now. It's not too big for its britches because the company still continues to target
Where'd that actually sell off?
gross margin expansion in fiscal year 2024.
Is there some kind of leak?
Between a 10 and 30 basis points of adjusted EBITDA margin expansion, and that would imply adjusted EBITDA of approximately $1.085 billion at the high end.
So you know what's so interesting about these makeup companies, Renita, is a name like Coty. We've seen it's up over 40% this year, so it's been really strong. Another name that's seen that same degree of strength is actually e.l.f., which is eyes, lips, and face beauty. That name is, I mean, killing it this year. And then I was looking at Estee Lauder, which is the complete inverse. So this makeup market I can't figure out. I'm assuming it has a lot to do with what is on trend and people sort of flock to the brands that are all over TikTok. I do know that is a huge market right now for a lot of these makeup companies. But as far as Coty goes, we did see they launched their Burberry Goddess fragrance, setting new market records. I mean, so it's surprising to me actually that we're still seeing some degree of modest guidance given all of these metrics that we laid out that are quite bullish.
It is, and I think that they are taking account for what everyone else is, but they may not just be saying it outright right now. The fact that a lot of consumers are going to pull back as the year
we get
goes
a bounce.
on because
We're
of the
buying puts right here.
macroeconomic conditions. They may not have said that, or they may come out and say it anytime soon, but you have to account for that these days in retail.
Yeah, and I wish that I could pull back on my makeup spending.
Something you might find interesting here,
There's been
Jenny,
scaling
you said
puts sooner.
70% of revenue generated outside the U.S. For Coty as well. 125 countries and territories. This thing's all over the place. China, Brazil, England stick out. But again, another company primarily international revenue.
And I think that so speaks to some of their luxury offerings, because the luxury market is so hot overseas, Europe and China being more dominant than we do see here in the U.S. So it's a really interesting name, and a name that has held on to its 40% gain. So I like to see that, despite about a 10% pullback from highs. We will leave it there. Great breakdown, Renita Young, senior markets correspondent for the network. Now, coming up next, we are about 13 minutes away from that key Fed announcement. We'll be discussing what can be expected, although I think markets are pricing in a lot of what they already think. But George Tillis will have that breakdown for us coming up next.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us, Chris.
Be tempted to get more calls again. All right, 12 minutes. Drinking a coffee. First coffee I've had in like 4 days, maybe. I'm trying not to drink coffee every day. I've done well. Today was a good day for it, though. A little hungry still after my late breakfast. I was up pretty early. Got those calls, Jay? Nice. No puts, no hedge? Just the calls? What's your plan with them? If it drops, you're gonna sell them? Coffee's almost gone. Give it a couple more months. Maybe by Christmas. I've just been muting from my cough. Just kidding. No, it's pretty much gone. There's still phlegm in there sometimes though when I cough. It's very, very odd. What are you talking about, me? You don't do anything. I'm setting up a strangle. I'm legging into it though, so it's... Right now I'm too much to the long side. Usually we get a rally into it, so we'll have 9 minutes for that to happen. If we don't, I'm going to just get the rest of these puts. I'm trying to have equal value puts to calls.
Time, to be honest with you, get those core rates down. to levels that become more acceptable for the Fed to change or create a policy pivot to lower rates. So I think if you look at the way rates have
This was
moved
borderline
higher,
like
and the
leaked.
markets actually have behaved
Wasn't that
very well,
that big of
I
a
think that
move, but
speaks to the good side of
had
rates
volume and
moving higher. In other
pretty
words,
much
it really signifies there's a
some
high
velocity
demand for
there.
investment spending. And
It was leaked,
with
but then they
unemployment
were like,
still
whoa,
below
whoa, whoa.
4%,
Don't make
we
it
can
obvious.
consider this economy at a full employment rate. And of course, growth is still
Here we
above
go.
trend around 2 to 2.5%,
On the green.
which is where
Pump
it
it up.
really should be based upon our demographic
See high
trends.
today.
So I
It's
think,
right for these candles. Ready for a
pausing right
candle up to
now
448.
is probably the best policy decision.
Big
And if
old
you go
gap fill
out
up
and
there.
look at when
Or
the possibility
437.
of a rate cut is going to happen, you have to go all the way to June.
Let's get
You can't
nuts.
just look at the rates moving down by a quarter. There's a cumulative probability of greater than 50% that rates will start to decline in, of course, mid-2024. But that's a long way off. Things can change quickly. We could see a resurgence of, COVID, for instance, inflation. So, if rates stay where they're at, I think that's actually a positive sign for the markets, because you have to look at
Hopefully.
higher
Looks like I
rates
might
as
be able
a
to scale into
healthy
some
sign,
puts.
not necessarily a detrimental sign.
George, I was going to ask you to get me excited about the Fed, but you kind of already did with some of those answers. So I got something else for you here. I think it's been 12 times that the Fed has had meetings since they started this hiking cycle. Well, now we're at 6 and 6.
Come on, let's see
We've
if
been
you
up
want at
6
least.
times, we've been down 6 times, like the meeting
to
days
safety.
following this. But the last 3 have all been higher. So is this just a matter of the probabilities catching up, George? Or is this more about where we're at in the hiking cycle, where maybe early on there was some hawkish surprise, the velocity and magnitude of the moves were a little bit bigger from a rate hike standpoint, and now we're slowing down and the kind of general consensus we're almost done, be it one more, couple more, whatever it may be. There's not that
Definitely
like
some
runaway
coffee.
upside fear with interest rates now. Thoughts on that, George, as you see as we set the stage here for
I still have my
what
January
should
puts on
be,
SPY, so
an interesting Fed meeting.
this could be
Well, yeah, I mean, if you look at the rate of change,
the catalyst
obviously,
that makes
these
those very
last,
profitable.
quarter basis point hikes are certainly a lot smaller than some of the ones we had earlier. So that's going to create
Actually,
a
I maybe
smaller,
should consider even
amplitude
closing
of
those
move,
today.
I think in both directions for the market.
If it
So I
gets
think
that
the last
bearish, though,
three,
it's probably
you
going to be
brought up earlier,
continued
Jay did
move.
as well, have been relatively tame
Those are a nice hedge,
in
too.
reaction, and I think that speaks to the
Oh,
policy
I'm not even
plateau
talking about
that we're
closing
at
today,
right
though.
now. I think if you look at the way rates have firmed up relative to inflation, they're in a good position now to allow monetary policy to work through the
Yeah, I'm
system.
buying one more
especially when
put
you have
there.
real
Got 2 more to
rates
get,
or positive real rates, which we haven't seen, by the way,
but I'm running out of time.
since before the financial crisis back in 08, 09. So I think this is important, and I think
Come on,
this is
VWAP.
very meaningful. And I think at the end of the day, look at the market reaction. In the last 3 meetings, they've
There
been
you go.
relatively positive. And I think that's a good sign. And I think, at the end of the day, if they do maintain their position at a steady state,
I'll get one
between
more
now and, let's
VWAP.
say, June or maybe post Q1 of next year, the markets may end up faring well. I do see, unfortunately, a hang-up that may end up creating some problems in the markets, not monetary policy, but
I don't think this helped me at all to leg into him.
I've been talking about in the
I'm
last
like almost
month,
back to
if we
break
run
even
into
on
a
this
budget
triangle.
problem,
I just open it right now, I'd be
or
break
a
even.
budget constraint or potential
Okay,
government
getting one
shutdown
more there.
in October, that might be a challenge for the markets, because you have to think about fiscal policy, which is counter offset the tightening of monetary policy. We've been running budget deficits,
Would've been
quite
cool to be
large
like
ones, by the way,
pretty green on it.
since COVID, and they're still growing. And I think that's one of the reasons the economy has done extremely well, and also the markets.
Yeah, and George, I think that's such a good point. I think something that's sort of under-discussed is the
And
fact
I-
that we do have some key debt levels
If we
and,
can hit
and
this
issues
resistance
we've
up here,
worked through as a country.
444.
So we'll obviously be watching this Fed event very
Need
closely.
one
Great
more.
breakdown, George Tillis, senior markets correspondent here for
All these puts are
the
actually a little
network.
cheaper than the
That
calls.
does it for Alex and myself for Next Gen Investing for this Wednesday. Now coming up next, we do have the watch list with all of your live Fed coverage with Nicole Petalides coming up next.
There's VWAP. I'm gonna wait for this last one I need to get. Well, no matter what direction it goes, it's gonna go the other direction also, so should get an exit. If it rips, probably gonna dump. Maybe not lower than where it ripped from, but potentially, and potentially even just back to where it started from. All right, there's a rejection on VWAP. I'm getting one more. Got 4 minutes left. Okay. Strangle is set. Sell the calls or the puts? Since it's much cheaper, most likely, to get into these positions, it makes sense to just kind of keep it hedged for a while. And sell what's profitable. For a little bit of it at least. But that's a good question, actually. I didn't even know. So a straddle is the same strike. A strangle is with different strikes. It's funny, I thought it was different than that. Yeah, I guess these are strangles. I thought one was selling. All right, 2 minutes. 2 minutes. Be patient, but decisive. Whatever I do, I'm gonna try and just do it one at a time. Okay, 1 minute, here we go. Adjust. Ten seconds. Okay, there it is. Huge dump. Closing a put. Not huge, actually. That was pretty small. Down some more. Not a very big. It seems like it's probably expected. Probably hitting expectations. Algos are scraping through the wording on the
no change, no rate hike today.
filing.
And the next meeting is in November. If the government shuts down,
No rate hike today.
what will the Fed do in November? They won't have the data that they need. So let's see what's next. But in the meantime, I'm bringing in Ben Lichtenstein to take a look at how the markets are moving at this moment. I did see that the Dow pulled back a little bit. What are you noticing front and center, Ben?
Noticing a little bit of weakness here in the initial reaction, but I do want to point out everything is still relatively contained here. As I look at the news,
not
you
crazy.
pointed or mentioned here that they left rates unchanged, Nicole, so at 5.5%.
Closing another put. I don't know if I'm doing this right.
This was expected, right? I don't think there were a lot of people that were anticipating a move
Today, the focus is going to be on some of the outcome here.
I don't think we're. I mean, we might get a bounce, but I don't think we're going to rip past that high.
Which is now starting to
At least not for now.
12. Fed officials see one more rate hike this year. 7.
Once Powell talks, we could, of course.
Flat here, but
I'm closing his puts. I should maybe be closing 2 calls with it.
Rates higher for longer into 2024 and into 2025 in the June projections, it looks like. So again, I'm noticing a little bit of weakness in reaction too. We're seeing Treasury futures, which are selling off. Yields are spiking here. But
so we can get an exit on these calls.
Here, we're still hanging out just below last week's lows and right in the middle of the range that we established last month in August. Basically,
not a big move at all.
4,500 level in the S&Ps. We're just
I bet we're gonna get ripped with Powell.
480, but we're right in the middle of the range that we've been in for the most part since June, Nicole. But yeah, I think there's going to be a lot of focus here in terms of the
or at least rally into Powell.
It looks like Fed saying that inflation is going to remain elevated. Central banks remain highly attentive to the inflation risks, they're saying. Fed see inflation at 3.3% into the end of 2023, at 2.5% into the end of 2024. So they do see some easing over the next couple of years. 2.2 is the inflation projection into 2025. So again, inflation into the end of 2023, we're talking.
Actually, I can look at the percentages.
2.6%. This
is why it makes sense to make a strangle.
And in the
so the puts are up 340%.
So,
oh wait,
yeah,
what? That's so confusing.
Here, but this is going to be interesting to
it wasn't that big of a
watch.
move though. Not up much. Puts are up 66%. Calls are only down 50%. So very small difference in the two.
Where the 10-year was basically right back up to nearing 4%.
I'm actually like
4.35.
I guess that's what happens when you're hedged. Get a huge move. We got that move down, I was saying, wherever, 436. Then it would have been much more profitable.
I think that explains why the indices are coming off a bit here.
Yeah, thank you for all of that, Ben Lichtenstein. Great to see you, and obviously a lot to read through and interpret today as we're getting more information, and it's all breaking right here on Fed Day, Federal Open Market Committee, and we'll be hearing from Chairman Jerome Powell. Jay Powell will be speaking.
So 5.6% Fed funds rate for September.
As soon as he gets to that podium,
no change. I think this was expected. One more 25 basis point.
We bring in Joe Brusuelas, Chief Economist at RSM. Thank you so much for being with me. You've had a moment to peek at some of the details. Your thoughts?
Okay, so no hike. We all expected that, but they left one on the table, a little optionality there. It's better that they did that rather than take it off and then maybe have to go back and hike. Okay, this is an extraordinary dot plot and economic forecast. They brought the unemployment rate back down to 3.8% this year. What that means is the Fed no longer expects a recession. They're quite confident now in a soft landing. When you take a look out along the forecast,
the Fed funds rate
the median dot plot, or excuse me, the
increased from 4.6 to 5.1. So those that we're expecting a cut next year, most likely not.
Policy. Moreover, that could imply
that's bearish. That's probably what this reaction is from. Very small reaction.
Probably between 2.5% to 3%, and that
longer-term
dot went from 2.5 to 2.9. That's a big move.
Ben was just giving some of those inflation projections. He said in 2023, 3.3, 2024, 2.5, and 2.2 for 2025. When you look at this and the fact that now it's looking like 2 cuts in 24 rather than 4 cuts in 24, and that goes on what you're saying because they think they can achieve a soft landing.
That's right. They're very confident now, I think, about where the economy is.
Yeah, I wasn't able to get those puts at a great time. This morning would have been the best on a double top.
And we're going to have a real challenge first quarter next year. But after that, we should
just close out of all of it right now.
Just under 2%.
Green on it.
That's what this Fed forecast is telling us.
The Fed cannot mess this up.
No.
The credibility of the Fed is on the line.
That's right.
And I've had a lot of conversations about that.
Actually interesting when it bounces. I go less profitable, which is strange. They've already closed 2 puts.
Higher oil, you have the UAW
really weird.
strike, car prices
like a big bounce for it to flip.
You see CPI and CPI still
There's a
showing
bounce.
an inflationary environment. Why isn't
Strange.
the Fed doing something? And is there credibility?
Really odd. As it goes up, I'm
What say you?
Well, the credibility is definitely at stake. But
losing
when you look at
money.
the risk matrix, UAW strike, government shutdown,
I guess because those calls are out of the money, maybe.
Gasoline prices. Last thing you want to do is hike into that. As a matter of fact, this is all going to be rolling into October and possibly November.
Maybe I'll
If that's
close
the
a call
case,
here.
The Fed moves into risk management mode. They won't hike in November. Now, that doesn't mean December's off the table. They could. But what it means is Jerome Powell's going to have a natural out here on that. Now, my view here is they shouldn't. They should be finished.
I'm going to close one of the calls
This is
here.
also, you're going into an election year.
Yeah.
And they don't want to mess this up.
Guess I'll just slowly scale out of this. I don't know.
With inflation and then some rate
It's so much easier if it's a huge move and the premiums you paid for the hedged leg are just, you've made 2-3 times that.
Yeah,
It's like, oh, whatever, I'll
economy's
just
gonna slow in the fourth quarter, and it's
hold
going
it.
to be barely there or negative in the first.
This is a little more
Right?
tricky trying to
So
exit it.
What we have here is the Fed's going to wrap this up quite quickly, whether it's my call, which is we're done, or they do one more. Then we think second quarter of next year is when you get the first set of rate cuts. Why? Because we got to start focusing on real rates and stabilizing real rates.
Yeah, that's what we wanted to talk about.
I want some calls though, because I think we'll get a bounce with Powell.
Real rates, you were looking at that. Tell us more about that.
Sure. So when inflation comes down, real rates actually increase. So if the Fed's higher for longer and on pause, that doesn't mean we're stabilizing. No, actually what it means is that further financial tightening across the real economy will continue, and you're going to squeeze the real economy. That's how you end up with the unnecessary end of the business cycle. What the Fed wants to do is ensure a continuation of the economic expansion, stabilize that, then prep the ground for those rate cuts that both the Fed thinks and I think are coming likely in second quarter of next year.
Yeah, and now at this point, you noted the unemployment rate, which is going to stay really at, it's basically full employment.
That's right.
Right, and the Fed, there was talk about if they kept raising rates and then caused more unemployment, but they managed to do it without having people out of jobs.
That's right. It's quite a policy achievement, right? Even with the loss of credibility. Look, the Fed thinks 4% is full employment, and they're telling us it's only going to 4.1. That means this
10 minutes
economy
after
is going
2.
to have a historically tight
Got 20 minutes till
labor
Powell. We'll
market
listen
for the
in.
foreseeable future. This is
Got it
really
queued up.
important for both investors and firm managers and other policymakers to understand this isn't your grandfather's economy and it's not your grandmother's labor market. We're in a new world.
Look, they're not ruling out the November hike, as you noted. They left on the table the possibility for another hike. In the meantime, you think about Janet Yellen. You and I were talking about, former Treasury Secretary. I mean, it's just amazing. I mean, former Fed head. It's just amazing to see what's going on in Washington. I'm curious to see what she thinks at this point now.
Well, Janet thinks that we can run this economy hot. She's somewhat of a dove when it comes to labor markets and policy. So if you think about it, this is Janet Yellen's economy in many ways.
See, this is what I mean. I think they do a lot of talking in Washington, and while the Federal Reserve is not supposed to care about the markets or things like that, and I guess they don't, but I think that there's a lot of minds going to work. And we've had some of the people change, right?
For whatever reason, it's
some of the changing of
more profitable as it comes down, even though I have more calls than puts.
went to go be on the economic
I guess
team
because
at
they're in the
White
money.
House, right? And then someone else came in.
Or they're in my calls are so far out of the money they've already.
You have a good point. For our entire career, Nicole, the market's been front and central in policy. After the events of the last 8 years, it's just not. After the events of the last 15 years, it's just not. Sometimes it's even a second order condition. So what's going on in terms of policy land is they want to keep that unemployment.
I don't want to keep closing puts though. Can't help but think we're going to bounce out of here.
Inflation. Right now we're about 0.5% above inflation in terms of income, which if you think about where we were last year at 9.1%, again, an extraordinary policy accomplishment, right? And that sets up for the election next year. Look, no one's going to call a recession next year, and the Fed's not going to hike rates next year. I think we're done now, and we're going to be moving into the new era, the post-pandemic era.
I'm going to close one more put.
Really good stuff.
It was supposed to be the roaring 20s.
It still may be, but
so
not quite yet.
At this point now, what is your advice to
We had the roaring 20s.
investors?
It was 2020. What came after that?
Okay, for the household, don't take unnecessary risks with
This is the FOMC.
It's okay. You've
So
seen
interest rate.
pretty big nominal wage increases over the past 3 years, and now you're seeing gains above inflation. Don't take undue risks. Okay.
We'll get Powell in 20 minutes, so we're going to get some more volatility.
Tailwind in terms of policy around infrastructure, the environmental transition.
I'm going to keep one put on.
Advanced or sophisticated microchips.
I still have 3 calls left.
Opportunities there. And then there's artificial intelligence.
Right.
If you just take a look at the supply chain around NVIDIA, to me that's a long-term secular bull market. It's going to happen. There's going to be competitors. Look, I'm optimistic. That's a productivity play. You know what happens when productivity increases? Everybody's standard of living increases. It'll be like the 1990s.
Yeah.
Well, it may not be the roaring 20s like it was in the 1920s.
Yeah.
We're going to do well.
Yeah.
I'm optimistic about it.
All right. Well, this has been a lot of fun. I love having you on to help me sort of comb through all the news as it breaks. Good to see you.
Now I'm a little more bullish bias. So I'm seeing it more when we go up. I'm not actually losing value on this play.
We will bring you that press conference live. Stay with us, Schwab Network. We'll be right back.
You know, I do. You know, the Fed is a little bit split on this. You know, I think you saw 12 out of 19 members thinking that there's going to be, you know, one more hike this year. You know, there is an outlier or two out there thinking there's going to be more hikes next year. That's certainly not our base case. You know, we do think that the Fed is probably done here. You know, obviously they didn't go today. You know, the weird kind of thing with the potential shutdown at the end of this month, the government shutdown at the end of this month, they won't be gathering data. So if this is a data-dependent Fed, they're not going to have data to go off of. That makes November on the margin a little bit less likely to go.
Yeah. I mean, I saw one article that was saying the Fed could be flying blind in November. I mean, they just won't have the data. We'll be getting PCE and all the prints.
There's a bounce on SPY.
They won't be able to make a decision, particularly if the government shutdown lasts more than a month. I mean, it really could be, and that could also slow the economy. So the Fed really won't make a move in November. They could in December, I guess. Let's talk more about 2024. You mentioned 2 cuts rather than 4 cuts. Originally, the anticipation was for 4 cuts. Now we're seeing more likely 2 cuts, which means that they don't see a recession. On the contrary, they see a soft landing, right?
Yeah, that's approximately right. I don't want to push back. I'm not going to push back on this notion that we went from 4 cuts to 2 cuts because that's what the math says. It's relatively clear. But I do want to call attention to the fact that it is a really like a razor thin margin between 2 cuts being priced for next year and 3 cuts being priced for next year with respect to how the Fed's thinking about it. We're talking about 1 voting member switching, going higher or lower. So, you know, this was a really tight contest, and the market is taking account of that. If you look at market pricing for next year, you know, we went from basically having a slightly more probability to having 4 cuts to a slightly more probability of having 3 cuts, but nobody is pricing only 2 cuts for next year, at least in the market right now.
I mean, when we think about the global picture, too, I just had a great conversation with Joe Brusalis, but I didn't bring it out to a global environment. I mean, you have China, you know, obviously not taking off, slower growth there. You still have tensions, Ukraine, Russia. You still have China, Taiwan is a possibility of a risk or a black swan event. And, right? Oil's been running hot. Your thoughts on the global picture and how that could affect us here at home?
You know, the U.S. is generally fairly isolated from global things, but Nicole, your point is well made. Like all the sort of tail risks that we see out there are to the downside in terms of economic growth. You know, China is a big one. You know, getting China to at least stabilize would be pretty helpful to the global growth picture. I'm not sure that's really in the cards over the next 3 to 6 months. Their property market is pretty challenged, and they're a little bit, you know, hands are tied on the policy standpoint. But you're right. I mean, Europe's not doing great. You know, Asia ex Japan isn't doing great, especially because of China. And so there are sort of downgrades kind of around the world. Strengthening oil market, though, is actually a sign of resilience in the global economy. So, you know, there are sort of some things out there to worry about. But the commodities markets are telling you that we're going to kind of see through this. We're not going to boom. We're probably going to muddle our way through.
Yeah. What about some of the things now, as Chief Investment Officer, I'd like to hear what your advice is to investors, because we have a few things that are brewing here at home. The UAW strike, for example, higher rates that consumers are facing. And as an investor, what should they do with their money, for example?
You know, we actually think it's a pretty good time to start tiptoeing. If they've been out of the equity markets, it's probably a pretty good time to start tiptoeing back in. Because, you know, I heard your previous guest, and I agree with most of what he said. You know, we're on the cusp of an AI revolution that's very similar to what we had in the mid to late 90s with respect to the internet revolution, and the impact that it had on productivity. You know, the U.S. is, you know, we are just grinding along. You know, we are in a high nominal GDP world right now, and a high nominal GDP world is really good for corporate earnings. So I know it's tempting to sit there and look at a 5% CD or get 5% cash or a brokered CD or something like this, and think that that's safe. But you could also get that in 1994, and that was not a safe thing to do. Earn 5% when you could have been earning 40.
And so, yeah. And so at this point, right, I mean, I know you were talking about the AI revolution, and it's been exciting. I mean, tech has been incredible. I mean, I would like to hear what you think even about the Magnificent Seven, because people know those names, and it's number one when you talk to folks, right? I mean, they just love those names. But just, you know, any final thoughts you have at this point on this day?
I think the press conference is going to be interesting. This is a place where the Fed is certainly, they downgraded the number of cuts they're going to have next year from 4 to 2
All right,
or
9
3.
minutes.
But there are still cuts. It's not zero. The Fed itself thinks that they're going to have to cut rates next year. And cutting rates in an environment
Stay
with
within and go
still
beyond.
elevated inflation is this really weird kind of concept of a neutral cut. And again, this is something that your previous guest referred to. Cutting rates in the face of inflation going down. It just
The only response I have to that is
policy.
eyeballs.
But that nuance is going to be really complicated, and we think that Powell or the Fed governors are going to have to start talking about this, well in advance of having to do these cuts, so the market doesn't get the wrong idea and run ahead of itself with respect to risk assets. So we think the press conference is going to be interesting, and Powell's going to have to kind of thread this needle as he always does. But that is the thing we're going to be looking
GME is
for.
up 1.5.
Do they start talking about a neutral cut for next year and getting the market ready for such an environment?
Right. Scott, great to chat with you today. We really appreciate you being on here on Fed Day. Breaking news moments, Scott Ladner, Horizon Investments. Coming up next, Chairman Jerome Powell will have his opening statement shortly, and we'll bring that to you live as soon as we get it. Coming up.
Whoa, big drop on Celsius. Oh, earlier today. Big news on that. Profit taken. Lots of profits to be taken on this stock. Maybe there's news on Monster. I don't know what it was. Yeah, it's weird. Spy gets like just a specific spot, and it's like the it's like the space between the walls where my calls aren't profitable, like doing enough against my puts, and it's like least value. Even though I'm more long now, it's strange. What's up, Bubba? What's up, Shay? I'm keeping one put as a hedge, and then I'll start to scale out of these calls. Usually we're kind of bullish coming into Powell's. You're seeing a little rally here into them. There's your Powell push. 6 minutes to go. Hello, boys. I'm back. Kind of like that. So the news was pretty bearish. Here goes SPY. So strange. Only one put. 3 to 1 of my calls a put, and it's still Same price here as it was here.
And derailed. I think that's a good sign because you have to look at the positive signs from of higher rates. It really signifies there's strength in the economy and also high demand for investment as well as high return on investment. So I think this is a good pause, but it's also one that maintains hawkish stance.
So it says here, that they're talking about the recent indicators suggest economic activity has been expanding at a solid pace, and we've seen that. We've seen that in the CPI and PPI prints, and we know that we have tight labor market. We're basically at full employment at this point, and the forecast going forward, the revised forecast from the committee today is higher GDP, lower unemployment, and fewer cuts, maybe 2 or 3 instead of 4, for 2024 because they won't need them. They won't need them. And so I thought that was exciting. I also think, as inflation comes down, real rates go up. So they're going to have to cut at some point, right, to keep everything afloat in the same way.
Well, yeah, ideally speaking, here's the thing. I mean, one, you have to think about rates falling, typically speaking, especially when you're at a policy plateau
3 minutes
or
for
cycle
Powell.
peak. When rates start to fall, it's not necessarily a good sign. Rates typically don't fall for good reasons, but I think the situation may be a little bit different because if we start to see inflation start to fall, the Fed could target, lower rates by, let's say, 25 or even 50 basis points and not, again, signal to the markets that in the economy that the things are getting really bad. I think they may make an adjustment next year based on inflation coming down. Again, if you look at the cumulative probability of a rate cut, it's not until June of 2024, which is 8 months or so away. That's a long time. Things can change between now and then, but overall, I think they're in a good place right now with rates, again, slightly above the core inflation rate, at least the federal funds rate.
I think things could change between here and this press conference. I mean, any moment, right, we could start to hear something different from Powell. I think that I'm in agreement with you. I believe we'll hear somewhat of a hawkish tone in the press conference because he really doesn't have anything to gain to sort of allude to the facts or anything like that. And things that have been going on. I mean, we still have some cards from the UAW and China, and oil has been running high. Some wild cards, and of course the government shutdown for our economy.
Oh, definitely. I think, one of the things I talked about with Oliver, earlier this week is that, the markets could face some challenges because of some exogenous shock. It could be some geopolitical issue with China. We have to think about COVID. That also could be another problem that could come down the line again. The other thing is I think the fiscal front is really what the markets have been focused on in the past year with monetary policy tightening. We've actually had, budget deficits, which really are in line with recessionary deficits. And so I think that's one of the reasons why the economy and even the markets have held up well. The fiscal policy has offset monetary policy restrictions. So, the budget reconciliation issue coming up, I think maybe a hang up for the
supposed to be
markets.
on.
That's, again, something to consider as we move into mid-October.
Yeah, without a doubt. And just the final thought
here.
When we look at the dollar and things like that, and I think that's another element that they watch all these things when they look at the cross currents and how the U.S.
No Powell yet? That's bearish.
around this 104, 105
Market doesn't like that.
level. He should be coming to the podium, but any final quick thought?
Yeah, I think at the end of the day, I don't think they're going to surprise us with any change really in language and stance. I think, it's going to be steady as you go for the Fed on a forward basis. And I'd like to see what they really look at for the forecast for inflation moving into 24 and maybe 25,
George,
or when they
jumping
expect
in.
potentially.
Federal Reserve Chair Jerome Powell.
What?
Our dual mandate to promote maximum price stability.
What the heck?
Look at for the forecast for inflation moving into 24 and maybe 25,
George,
or when they expect.
What is going on?
Reserve Chair Jerome Powell.
Our dual mandate to promote maximum price stability.
Alright, I need to get on YouTube. This is stupid.
Early last year, the FOMC has significantly tightened the stance of monetary policy. Raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate.
I can't do picture-in-picture now.
Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks.
Back to
I will have
BWAP.
more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged
Closing one of my calls here.
150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment
Such a tight range for an
projection in
FOMC
the
day. This is
SEP
crazy.
rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Other data, we estimate
Don't.
inflation remains well above our longer run goal of 2%. Other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process
This
of
is
getting
all
inflation
pre-written statements, so
sustainably down to
nothing
2%
new here.
has a
Market
long
still
way to
reacts,
go.
so it's pretty funny.
The median projection in the SEP for
Market loves
total
Powell.
PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. Target range for the federal funds rate
Oh my gosh, dude.
At 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal child care funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First
Such
of all,
a tight move.
Real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around
I'm about
lag
to
times,
cut these calls and
too much
get
slowing,
more puts.
too little slowing? Could you walk us through
Looking for
what
better
this
X on the
disagreement was about at the meeting?
calls.
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions. And really what people are saying is, let's see how the data come in. We want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received,
Purple tide's bullish?
was a good example of what we do want to see. It was a combination of,
I think it's neutral.
Of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
And in your view,
Somehow
what
gone
would,
green to
I know
red.
Nothing has been decided yet, but what would one more hike at the end of the year do to the economy
Chop
or to
around
inflation?
right where it
and on the
can't.
other side, what
This
would
play.
no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it as we've gotten closer to it. We've slowed the pace.
So for Powell, this is a very
moved. I
small
think
pump.
that's
That gives you an inclination of what's going on.
Now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell you that, does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we
I don't
start
think
to
he's going to be able to
hey,
say
maybe
anything
the
that's going to make
longer
this
rate or
market
the neutral rate
very bullish.
is actually higher? Thank you.
So I guess I would point more to, rather than pointing to
Like, get one
a sense
response
of
to bring it up
inflation
here,
having
but-
become more persistent. I wouldn't think that's not. We've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates. We have to do more with rates, and that's what that meaning is.
Look at my
telling you.
softball question. We got these calls.
In terms of what the neutral rate can be,
GME's liking it. It's up 2.3.
We know it by its works. We only know it by its works, really. We can't.
Back to that
can't,
resistance.
The models and that the economy reacts, and again, that's another reason why we're moving carefully now, because there are lags here. So it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate. And it's certainly plausible that the neutral rate is higher than the
Okay.
longer run rate.
I'm out.
What we write down in the SEP is the longer run rate.
I'm out of the calls.
It is certainly possible.
Just have
that,
puts now. Wow, look at that.
That the neutral
Just in
rate
time.
at this moment is higher than that, and that
I added
that's
to my
part of the
puts and closed my last
explanation
calls.
for why the economy has been more resilient than expected.
Probably just look for more entries on more
Howard Schneider
puts.
with Reuters, thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the
Now-
labor market.
now the accounts move a little
without
bit, now that I'm
increasing
one-sided.
unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things, so that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market. That can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better
10 minutes
balance.
to power hour.
All of those things are happening. You're right. In the median
A little more
forecast,
red there
we
on
don't see
SPY.
a big increase.
And I barely got out of that in
We
time.
do
That was
see an
crazy.
increase. And but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing.
This is,
Progress
I think, the
without
smallest
higher
move,
unemployment.
tightest move we've seen on
So just
FOMC.
to boil that down for a second, we've gone from a
The
very
last 2
narrow
years,
path to
or at least
to a
tied with
soft
it.
landing, to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've
What's
said
he saying
that
if he's
since
not
we
saying
lifted
soft landing?
off. It's also possible that the path has narrowed and it's widened, apparently. Ultimately,
Was he flipping pages?
this may be decided by factors that are outside our control. at the
Oh
end
my
of the day,
gosh.
But I do think it's possible.
That doesn't
and,
sound
you
good.
know, I also think, this is why we're in a position to move carefully again.
Should have closed one put
that
there.
We will restore price stability. We
Oh,
know that we
flushing
have
through.
to do that.
That's
we know
nice.
the public depends on us doing that. And we know that we have to
Like I
do
said,
it so that we
440,
can achieve the kind of labor market that we all
50
want to
area is
achieve,
kind of
which
our
is
low.
an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying.
An entry for more puts.
I think, that's the end we're trying to
Close.
achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
I'm going to close one put here. One of the 442s.
Nick Timmeros of the
No,
Wall Street
443.
Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will
He's
be
going to get a
judged
softball
on a
question. He's
real
going to
rather than
buzz a
nominal
bounce.
basis,
I'll get more then.
implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's
Did
a
it
real
bounce off
rate
the
that
low
will
there?
matter and that it needs to be sufficiently restrictive. Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates. And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing enough data that you feel like, yes, okay, this feels like we can for now.
AMC starting to sell off.
The right level.
Red
and
now.
Just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say, if we get to that level, and then the
You'd be
question is
selling
how
off a little
long
bit
do you
too.
stay
That's
at that
weird.
level? And that's a whole other set of
Down to
questions.
VWAP.
For now, the question is trying to find that level where we think we can stay there, and we haven't gotten to a point of confidence about that yet. That's the stage
this year, and even then, it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Such a muted move so far in the market. It's crazy.
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation, kind of again to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that
Market
may
likes
be
that, of
that
course.
real rates are rising because inflation is coming down. Part of it just may be that
I need my put there.
it'll be all the factors that we see in the economy. And, you know, that time will certainly come at some point. And what you see is us writing down, you know, a year ahead estimates
Still pretty
of what
small
that might
position
be.
sizing.
And, you know, there's so much uncertainty around that. When we, in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Neil. Thanks so much, Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth that we've been seeing is driven by excess demand versus supply side factors, productivity,
You need to
labor
break
force
this
growth?
level.
And
Got an
relatedly,
inverse cup here.
if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, I mean, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. You know, the consumer's been very robust in spending. So that is, you know, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's, you know, you're expecting to see this improvement, you know, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and you know, we'd be looking at GDP just to the extent that it
Look at that wick.
threatens one or both of those.
Victoria. Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But you know, it's the strike, it's the government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. You know, there are a lot of things that you can look at. And you know, so what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other. But we do have to make an assessment of its economic effects to do our jobs. So, you know, the thing about it is so uncertain. It will depend. The economic effects, it could affect. We've looked back at history. It could affect.
Wanted to get more
economic
puts. Oh well.
output, hiring and inflation.
If I get
But
another
that's
entry.
really going to depend on how broad it is and how long it's sustained.
So fast, these candles,
and
these
then it
wicks.
also depends on how quickly production can make up for lost production. So none of those things are known right now.
Might not get a
Very,
break
very hard
until Powell's done
to
talking.
know. So you just
There's
have to
power
leave
hour,
it
10
uncertain
seconds.
And
YouTube also.
we'll be learning, I think, over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. You know, energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation.
Guess I'll close one down
so
here.
the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but I mean, ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Greg Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime-age labor force participation.
I want to hold these
moving
puts,
up,
but I got to
where
be
people can
careful.
add skills. Workers want to work. We have a boom in manufacturing,
Gotta realize some
construction.
gains here.
We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and
like
Fed
the last
coming in and having to tighten again.
3
and again.
years?
So the best thing we can do for everyone, we
What's a long
believe,
period?
is to restore price stability.
5 years?
I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of
Gotta close
being
another one
able
at the
to
low of the day.
continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy.
See if we can
was
flush
going to
through the
help.
lows here.
It was going to help.
I don't know if we're going to get
supply
much
side
movement
healed
now
by-
while Powell's
by
talking.
cooling demand off.
Might have to be
And
once he's
just in
done.
general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Okay, closing one there.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5.
This lag, dude. What?
What would justify that last move? Because the median forecast is
It must
for
be YouTube.
lower inflation.
Market volatility.
Given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your
I
question,
don't think I've ever seen his glasses so low.
what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last 3 readings are very, very good readings. It's only 3 readings. We were well aware that we need to see more than 3 readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the 3 buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But These are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening becomes more equal. And I think the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage
Close another one
of the
there.
fact that we have moved to
Risk
move
up.
a little more carefully now as we
Again, I think it'll probably have to be
find our
he's done
way
talking.
to the right level of restriction that we need to get inflation back down to 2%.
Oh, here's our flush.
Thank you, Chair
Oh,
Powell. Jennifer
there it is.
Schonberger with Yahoo
Do it.
Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's
Can it
more
do it?
likely that you'll have a low PCE number
There it is,
that
new
would
low
make
on
you
the
feel more
day.
comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report,
Puts one up, yes.
impact
Calls-
your approach in upcoming meetings if we were
calls
to
went
have
down.
a government shutdown?
I've been just legging out of them.
The first question, what was the miss?
For how well I've timed it, it's
The base factors.
my P&L is not reflected of it. We're green, but it's not a huge day because the move is very small.
So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right, when you go back 3, 6, and 12 months.
9% on the account,
but
which
we can.
I was hoping to have like
adjust for
100%
that.
today,
In terms of not getting data, again, we don't.
but can't force it.
We don't comment on government shutdowns.
Could have been
it's
read.
possible, if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects that as those kind of fall out of the equation for the next couple of
Yeah, I'm in
readings
0
by
days.
November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, if we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And
So far, the market maker basically won on this.
What we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation and things like that. That's just things we have to monitor. So,
Oh, yeah, on the consumer, they're putting more and more of this on their credit card. The consumer seeing, record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully.
What?
But at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was the typical in the pre-pandemic
What's
era.
he talking about? They're not. I don't know what he's talking about.
Hi, Jean
They're
Young with
much higher than
Market News. Yields
China
along the
virus.
Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro
There's a new low on
explanations and how much
SPY.
to technical factors?
So you're right.
Oof,
Little
little
rates
flush.
have moved
I
up
was hoping you're going to get
significantly.
another good
I
entry
think,
for puts.
It's always hard to say
This was
precisely.
it. I only
but
got one.
It's
Well.
most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things. Either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because
Wait
of
for the
inflation.
support to close
It's
the last
because
put.
It'll probably have something to do with stronger growth. I would say more supply of treasuries.
No, yeah,
the
I mean,
common explanations
he's
that
trying
you
to
hear in the
make the economy
markets
sound better, of
kinda
course.
makes sense.
But yeah, I mean, I'm surprised he even said that still.
Kyle Campbell, American Banker. Thank you for taking
Like-
the questions.
Yeah,
Just two
credit
on
credit debt.
housing.
Much
You
worse
said
than
slower shelter cost growth
pre-COVID.
is in the pipeline and will reflect in
Savings
inflation
worse also.
ratings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from
More
homeowners
flushing.
about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point,
Nice flush.
of
Wish I
course,
had more
supply
contracts.
is very
Oh, well.
important over time in setting house prices and for that matter rents, and supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is
Getting close to that sell
leases that are
spot.
running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look
Yeah,
at
close the last
look at
put.
the lock-in. The
Look for an
idea
entry
being
for
that
more.
people are in very low rate mortgages, and even if they want to move now, it would be hard because the new mortgage would be so expensive. Play a role in our future decisions in a future loosening cycle about whether we would cut rates. No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road, I wouldn't think so.
Hi, Nancy Marshall-Genzer
right.
with Marketplace.
Might be done.
Chair
We'll
Powell,
see.
you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown,
Just
high
like another
gas
day on
prices.
the market.
At this point, would the Fed welcome a decrease
big engulfing
in
candle, though.
consumer spending? Would that
Bearish.
help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the
You wouldn't
the
look at it that
tightening
way.
we've done. It's a good thing that the labor market's strong. The only concern...
You want the opposite of all that for his job to be
It just means
complete.
this. If the economy comes in
Well
stronger
done.
than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, you know, we also now, given how far we've
I haven't had a
come
chance to reload.
with our
Want
rate
more of a
hikes and how
pullback,
quickly we've come here,
consolidating
we
at
do have
least.
the ability to be careful as we move forward because of that consideration.
New low there on SPY.
Thank you, Chair
Down
Powell.
0.5%.
Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
These contracts really actually aren't moving that much.
I guess it's fair to say that the economy's been stronger.
Ivy was so high, it's
than
like
many expected, given
and increased a whole lot
what's
from
been
there.
happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood.
There's more
And
flushing.
So that's spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. That could be, it could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are, who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so they're not going to. It's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate
Dish is down 1%.
Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? I just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly we're suffering from high inflation. I think during the pandemic, the government transfers that happened
Nice, Mr. Invest.
were very meaningful. And if you know the surveys that
big
we did
gainers?
showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
It's done. All right, we'll see what happens here with the market. We broke through and sold off even with him speaking. It's crazy, all the
Here,
lag.
it seems
And
like consensus is coming together a little bit, but are you talking about basically next year where there's a lot of variance?
There's a ton of variance, and we effectively just saw 2 rate cuts over the next 2 years come out of the dot plot. So that is, less easing equals more tightening, at least in my mind, and they increase their assessment of the economy as well. So there are a lot of things to me that dictate that policy is on a firmer path than what the market was anticipating, even though the market was saying the whole time, hawkish pause, hawkish pause.
considering more puts, we'll see.
Than even the market was anticipating.
Okay.
Probably try and get back,
I guess when
back up to VWAP though, so might even get calls. We'll
cuts happening by the market.
we'll wait this out a little bit. That is an engulfing candle though.
Cut is kind of hawkish at this point.
Well, yes, I think anything other than just a bold, outright statement. But of course, he did use the word carefully several times, and he basically said, if the facts change, so will we. And I think that's kind of the glass is half full interpretation.
A long ways to VWAP.
Taking with it, in addition to all of the things that we know are happening at one time in the economy, whether you're talking about the UAW on strike or the potential for a government shutdown or student loans. I mean, there's a laundry list right now. And he basically said, we're trying to game all of those variables, which increases uncertainty, but ... we're still getting to that 2% target. So.
Yeah, and right now, of course, as our previous guests point out, we're a good ways away from that for the Fed's preferred metric. But the economy so far has handled some pretty serious tightening over the
Okay, I actually got
past
some
12
puts here.
months
pretty tight stop. I'll flip into calls if we break some levels.
What do you see as the odds we can continue to do that? I mean, it looks like the Fed might actually get to a point where they revise down on employment expectations, which is kind of crazy to think about after last year's hiking regime.
It is kind of crazy to think about it that way, but yet, we have seen an extraordinary amount of fiscal stimulus. If you look at deficit spending, it kind of came down really hard after COVID, and it looks like a hockey stick going on its way back up. The question going forward, though, that's what markets care about, their forward-looking mechanism, is there any marginal fiscal relief coming towards the U.S. consumer to support consumption? The answer right now is no, not until after the election.
So that gives us a pretty good calendar, a kind of timeline to work from. What do you think the number one data point is, Danielle? I mean, is it just basically jobs? Is it purely employment?
Well, yeah, Jay Powell mentioned several times the consumer continues to consume. And I think that is their focal point because, of course, 70% of the U.S. economy is
Selling a couple of these.
So the labor market remains tight. I mean, he used that word.
It popped up
it's
pretty much right after I bought them.
Better balance. But according to him, as long as we keep spending money, then the Fed can keep tightening policy. And that really is where he focused his comments. In addition to saying, by the way, we're going to continue to significantly, quote unquote, significantly reduce the size of the Fed's balance sheet. So quantitative tightening isn't even up for discussion.
Yeah, good observation on his consumer commentary. Danielle, one point, since we were talking history with our last guest, you've got some history as well in your writing. I'm looking at your notes that two successive pauses have typically ended the rate hike cycle. So I guess that puts some pressure on November?
That does indeed. It does put the pressure on November. If you look back historically, if the Fed goes 2 meetings, that means that they're done. That means that they're finished. Jay Powell has a little bit of a rough track record.
See if we can break this.
With rate hikes in December. He remembers back to 2018. Yes, I would think that the onus right now is going to be once we get Fed speakers speaking again tomorrow. Now the blackout's over. I think that you're going to be hearing a lot of people guide markets towards that November date. And there's not a lot of time or data between now and then, by the way.
Yeah, very true. Great conversation, Danielle. Thanks for jumping on for us. Danielle DiMartino Booth, QI Research. All right, so we've got some cohesion in our macro analysis from our two economists this afternoon, both pointing out that Powell still means business about getting inflation down. That means the market is likely very wrong about pricing in cuts as soon as it is. When we come back, let's trade some options.
Yeah, I'm out of those puts.
We'll return to this subject, of course, in our big picture panel with the Schwab team going into the closing bell. Let's do some trading between now and then. And actually, the Tesla conversation probably is very much a macro conversation. The chart intraday there speaks volumes.
Kind of think it wants to move back up for end of day. Zero day puts hit. Nice. Well done. I got a channel live. I don't know who that is. Yeah, little double bottom there. I mean, that's also an inverse cup, so I have a little handle built. Doesn't always have to, or it could just be a double bottom before we go up. Would have been a better exit there on some of those puts. Just grab one call. Oh, no. Closing it. Yeah, this is what I was holding the puts for, but I got shaken out. Shake it out. Trying to close them at low of the day, but oh well. That's what happens when I still have buying power in today. Gonna get the last couple points. Last fraction of a point on the bottom, while simultaneously trying to time the reversal. I don't have a rule about buying during power hour. It's a loose rule. Look at that flush. So 439.94. I try not to hold through Fugazi. Today's a little different too, since it was Powell day. We didn't get much of the natural. This actually was pretty natural, but it's still Powell. Because he wasn't answering anything that was like market moving, so the algos just picked it up and went with it. But now we're seeing it more played out. Ah, those puts. Those have been another 30-40% right there. I don't know how I could watch other stock YouTubers. I'm streaming all day. Bugger. Oh well. Missed that move. Glad I got out of the calls. It's just a last little bit. Last little move down here. Flicker, 15% on that thing. Insiders finally stopped selling. Dude, that's a big candle, dang it. I got scared. Just when it's made its move, it's hard to not be skittish on the way. Getting some calls there, shoot. Too far out of the money. No, look, it's still going. Unexpected. Where are we? Yeah, I suppose so. I think it's trying to set up an RSI divergence right here. Need that call to be closer to the money at the end of the day. Not thinking. Needs to be in the money this late in the day. Wow, look at this. Yeah, I used up my buying power, now I can't overtrade. I got calls. I got in the money. When I'm not, I have a family. I don't really do a whole lot of watching stuff on my own. And most YouTubers aren't family friendly like yours truly, Happy Money. Golfing candle there maybe on liquor. That'd be neat. Shake your booty. But yeah, no, I shouldn't say that. I mean, I'll keep track of some, not like any streams, but I'll watch some videos. Let's see, who do I watch? I watch some of Zip's videos, Zip Trader, some Trading Fraternity, some Spy Day Trading, some Meet Kevin. I don't like, none of these am I like watching every video that they come out with though. It's kind of, I definitely don't watch any streams. Fucking weak. Wow. Wow. Stupid me giving back some gains here. $340. More flushy flush. Yeah, it's weird. It's like the contracts finally started moving after Powell was over with, actually. That would be very bearish if we closed the day down here. That's crazy. Yeah, I'm definitely gonna close these calls on a bounce. Not in these red candles. I watched the PP show sometimes. There was a bit there where I'd listen to it at night, like going to sleep. It's like puts me to sleep really well. But no, I haven't been. Can we just get to 16? I think we will. Yeah. Maybe 16, maybe 15. I mean, if it's taking it pretty bearish, which it seems it is, you get some real cheap prices on GME. Dang, I'm gonna be holding these through Fugazi. We might not get our bounce till then. I'm assuming we'll get a somewhat of a bounce. He's back up here. 440.23. That is an ugly close. You're gonna probably have a gap down. Close that low. Go. Those first calls I bought, I wasn't paying attention. I got 441s. Kind of stupid this late in the day. Hmm. $18 minutes. Market is not wanting to bounce yet. No one's buying this up. Trying to squeeze a little bit more profits. Yeah, for an FOMC day, like it was, I don't know. I haven't traded the strangle that often on it. I think maybe 2 or 3 times for a Fed event type day. I think I would have done better just trading how I normally do. Seeing that just the first candle, whichever way it is, and just going for that direction, then closing and flipping. If we get a 15-minute move, we're really gonna have to wait for 10 minutes. Getting eaten on theta on these now. Validating at the lows.
And stocks are at the lows.
Well, I guess I'm happy I didn't blow up my account today. I was pretty heavy into calls.
I mean, when you
I
look
think I
at
got
the
puts
reaction
just before that opened up.
Fed announcement slash
It was at least strangled properly.
conference, the dollar continues to push back up towards the highs of the day, right around that 105 level. And gold and silver have come off their intraday highs. They're still positive on the session, but you know, they are giving up some of the momentum that they had earlier going into the announcement. So even though you know, they're still higher on the day, I'd say that the reaction post Fed announcement has been somewhat negative.
Yeah, good eyes on gold. They're kind of drifting a little bit lower. You know, sometimes it catches that sort of uncertainty bid, maybe a little economic slowdown, but still inflation. You know, I kind of view that as what gold might like. But gold, we also know, doesn't like incrementally, surprisingly high interest rate policy.
Wow. Right. Exactly.
No
yeah,
bouncy.
and the market's interpreting what he had to say. And I think the key factor or the key point in everything today, Oliver, was the revision to the basically the expectations that they see Fed funds at 5.1% through next year. That's up 50 basis points from their previous projections of 4.6. And that's certainly playing right into the theme of higher for longer. And if that is the case, I think that's why you're seeing the markets reacting accordingly. Now you're seeing the short end of the curve selling off, pushing those yields higher. The 2-year up about 3.5 basis points. Now the back end of the curve, like the 10s and beyond, are flat to slightly lower in yield today. So their prices are slightly higher. So you're seeing, again, the expectations now being shifted in the yield curve towards the shorter end of the curve that rates are going to remain higher for longer.
Yeah. 2-year yield trying to get above the 5.11, which was the initial spike on the 1 p.m. headline. If the dollar does it, should we assume the 2-year is going to do it too?
Feels like it, yeah, and especially given the fact that the way the market continues to realize, you know, some of the momentum that's carried over as the press conference just recently concluded, that, you know, you're looking at the equity
15
markets
minutes
on their lows of the day and losing steam here as we move towards the close. So, Oliver, I'd say, yeah, the reaction has been disappointing, I guess, depending on how you look at it. But nonetheless, the Fed remained
this is crazy.
very hawkish, I'd say.
It's coming.
This
Just have
entire
patience.
process today. And again, why wouldn't they? You know,
Might
they're
get a
not,
drop
they're not going to
first.
change until they feel a need to change. And that's when something starts to break. And at this point, we just haven't necessarily realized that, particularly as you pointed out, the economy remains much stronger than they anticipated even earlier this year.
Looks like maybe the
I'm just getting theta. Getting swarmed by theta.
Of stock market implications for
my
future
theta
rate
zapper out.
policy. VIX, was it
Days after is a cash
just,
position.
3 sessions ago. So
You're
now
low
we're
there.
turning around, finally waking up as maybe the expectations
Yeah, I'm
got
out.
too dovish as expressed by stock valuations.
I
What
got
kind of
one
things
left.
might make sense if equity buyers have to recalibrate here to a higher interest rate regime.
That data burn was bad, even in the
I
money.
think that we'd have to break this range that we've been in for the last
That was
several
stupid.
months. That would certainly shake things up in the vol space. You know, we are trending higher today on the sell-off, and rightly so. Now that we're realizing
It was a small day, and I just
better than a 1% move lower.
not too
S&P
content with it, so
0.75%.
got a little
When you look at
gambly.
realized volatility over the last
That's
several
okay.
months, Oliver, it's been a very tight range, and it's been compressed. And it's very hard
I didn't like
to
the risk
sell game.
reward
It's very hard
this
to,
last little move.
you know, hold options for any length of time.
I went
if you
further
don't
than I
get
was
the intraday
anticipating.
price movements, and that's something that's part of the reason why we continue to see the compression in the VIX complex. If we break out of this range, then yeah, the action to that.
Coming into
Losing
Fugazi.
momentum now on the 50-day moving average. That's something I'm watching very closely. So if the further we drift away from that, and particularly if we start to trend towards those recent lows and break them, then that
This was basically my midday chop trade where I get my profits away. I had to do it at the end of the day because
we
I waited for Powell.
breaking out of this range.
Yeah, all right. So we're not quite there just yet, but you know, stopping the decline in VIX, it's got to be the first step if it's going to go anywhere higher. And
Yeah.
so in that context, an interesting kind of 3 days of trading here. But yeah, well within that range we've been in since summer, so it's a point well made. Appreciate it, Dan. Thanks.
All right, Oliver.
You got it. Let's check in on
Has to
the
back up to
brokers.
440.50.
Strike for autos. Jenny
Got one
Warren,
contract to
who's
make
next
up for the
gen,
3.
With the latest on UAW. Jenny, shares finally dropping here a little bit today.
Jenny.
Almost 2% for GM.
It's sort of amazing, though, because prior to some of the selling we're seeing with the overall market, you guys just talked to Tesla, which is also seeing that weakness. GM and Ford both earlier today touched their pre-strike levels. So it's been sort of remarkable how the market has shooken off some of these headwinds that are
Just
of course weighing on
consolidating down
GM
here,
and
man.
Ford. Latest news is the GM plant in Kansas City.
All right, we'll review the trades.
Idle today, which left
I've got one contract still open, so I'm kind of trying to get an exit on that.
now, the Fairfax plant, which is in Kansas City, was not called into strike last week, but are dealing with some supply chain issues, which is part of the problem we're seeing with this strike. So we did see GM leaders at the Fairfax plant saying they ran out of parts to then keep it operating, thus stopping work earlier today. A spokesperson for GM
This is
said
ugly
most
clothes, man.
UAW workers have
Even if we get a
already left
Fugazi
the
bounce.
plant just because there was no work available. So
Very
that
ugly.
plant wasn't even initially striking, which is what I find so
Nice
interesting
big
about
red
the
engulfing
story.
candle.
GM did say those workers will not receive company-provided sub-pay, which is sometimes provided during times of temporary
Too weak to even have a bear flag. It just bear flagged and melted.
These segmented strikes really across various plants. Striking workers could receive around $500 a week, but that strike fund we're seeing isn't bottomless, and Fairfax workers won't receive strike pay while they're being temporarily laid off. So obviously this is a painful situation for those employees affected, as well as some of these various auto companies. Goldman Sachs actually is estimating that Ford and GM stand to lose around 100 to 125 million in revenue per week from this strike. So this is seeing, a major impact, I'd say, to the company's bottom lines and also their growth. These were companies that were already struggling with profitability in their EV segments, so this is not what you want. Although I will say, I have to go ahead and disagree with Tom White, what he was saying about Tesla being the biggest beneficiary, because we so often say that Tesla's, not valued like a car company. This is not an automaker. This is a tech name. So then I don't really necessarily see them operating in the same market, in the same sphere as, say, like a GM or Ford. I think that we have to consider like a Toyota, a Volkswagen, some of these more comparable models. And
Here's 10 minutes Fugazi. Start with a red candle.
Because Tesla, I think, is in somewhat of a league of its own.
Spoken like a true next Jenner. Appreciate it, Jenny. Thanks. All right, nice. Good stuff. Thanks for the update. And yeah, Ford, GM kind of cracking as the broad market did, but otherwise have been able to kind of shrug off some of these
Just that green candle to VWAP.
When we come back, got a great panel to take us to the bell. Stick around.
I want to close this. Shouldn't have closed those other two. The candle scare. Okay, I'm out. Okay, time to review. That was fun. Not as fun as when I was at before, but that's okay. Too much trading still. All right. Didn't trade this morning. Was looking to get into calls and puts before 2 o'clock for the FOMC. I just wanted to basically pick up calls at lows and puts at highs. Missed this double top, unfortunately, in the morning. I figured we'd have a pump into the FOMC, which is pretty typical. So I was like, that's fine, I'll miss that one. I also didn't want to get into trades that early in the morning as the IV increases, or is really high, especially in the morning. So wanted to wait till a little closer. This was kind of the window. Anyways, missed that. First trade was, I started scaling into calls. Got one at 10.15. Right here on that red candle and that double bottom. One there. Got another one at 11.18. So somewhere on this candle. Got another test on that bottom. Got one at 120, or no. Got a put at 126. Where is that? Yeah, we're getting close. So I was like, I should need to get some puts. So got a put there. Right here. And then got another call at 136. Somewhere on this candle. And then 144, got another call right here. And then at 154, got a put, so it did rally up. Then 155, got a put, and 156 got a put. So 2 more puts on this candle. Just before FOMC. So I was pretty evenly strangled. 4 contracts, both ways. Value were similar. My puts weren't as good though. I didn't get them at the highs. Just because of the weak market. Anyways, yeah, then exits. Very small move on FOMC. Let's see. 2 o'clock, sold a put. Really? Yeah, 2 o'clock. Just had that first initial candle. I sold one. Wasn't here. It was on this candle. Sold one. Sold another one at 201. So I've sold 2 in this candle. Sold a call at 207. Somewhere in this candle. On a little bounce. Trying to just scale out a bit. Sold another put at 211. So somewhere also in this candle. Sold a call at 233. So somewhere in this candle. Near VWAP. Sold another call at 244. Somewhere in this candle near VWAP. And then sold. What did I do here? Sold. Oh yeah, this is when I totally closed out and added to my puts. Once I had a direction of bearish. So I sold the rest of my calls. 2 more calls. 247. So somewhere, I think near VWAP up here. And then bought 2 puts. So then I had 3 puts and no more calls. At 247. So somewhere close to VWAP, but as it was coming down. And then sold a put at 251. So I think kind of near the low. This low. Closed out one of them. We could look at this in the 1 minute. It'd probably be easier. 251, yeah, right here. Nice exit. Opened another put at 256. Yeah, I was looking to get more in. Right here, so not bad. 1 candle away from the high there. Little did I know I should have added more there. That was going to be it. Didn't have hardly any retracements on this down move, so not many options to keep adding. 256. Sold one put at 304. Oh, right here. At a low. Considering it's not going to break this, potentially. Let's see, was this when he was speaking? Yes, when he was speaking. So, thought he could still get hit with some soft questions that would make it rally. Wanted to take some profits. What was that? What time was that? 304. Right here. Yeah, 304. Sold one there. Sold one at 307. Right here. Again, just trying to take some profits. Sold one at 315. So once it broke that low, that was very good. Here's the 315 sell. Nice. Another support. Opened 5 puts at 325. This is when... This one? Yeah, it was this move here that I missed. So I was totally out of him, I think, at that point. So this thing, see, that would have been nice. Buys flushing out more, wow. I think I'm totally out, yeah. Yeah, I got into 5 of them here looking for a retrace, and then I okay. So anyways, bought back into 5 puts here. And then 327 closed one of them on that red candle because I wasn't sure. Still kind of stuck in this range. And sold another one at 327. And then sold the rest at 329. So just 2 minutes away from it making the move I was looking for. Yeah. And then bought a call, 331. So kind of on that candle. I bet at the top of that candle, I'm assuming. And then immediately sold it 18 seconds later. And then bought a call at 334. Right here. Trying to time the bottom again, remember? Stupid. And then bought 2 more calls at 335. Yes, that's right. And then $35, bought 2 more, so I had 3. And then I sold 3 of them at 346 on the next minute. That's not too bad, actually. And that's the last one at 351. So all looked good. If I held on to those puts here, which I could have been a little more patient. I had profits and I didn't want to give anything back, so. But if I held those, it would have been a much better day. And if I didn't try and time the bottom with the calls. That said, though, I'm pretty happy with it. And we have 30 seconds to go. We're up 5% on the account. Very small day, but it's green. I'm happy with that, especially with how this ended up playing out. Ideally, that I would have had a strangle. We would have had a huge 2% move to one side or the other, and it would have been easy just close the whole position and be up a bunch. Instead, we had this very small move, and then, yeah, so I was trying to time the in and out and in and out. Leg down, I liked it. I got a little over tradey right in here. I get anxious when it's at the lows. It's consolidating. It looks like it's gonna drop, but I'm like, it's already at the lows. I just don't think it's gonna drop more for whatever reason. So I always feel like it's chasing there, so that's why it's gonna, yeah. But there you have it. SPY closed down 9.2% or 0.92%. AMC down 1%. Big engulfing candle here on the daily on SPY. So I presume we'll be coming back down to the 431. And completing maybe this sort of weird inverted cup. And then see what we get. See if we get a bounce for a handle. And if we keep coming past there, we've got 423. My January SPY puts would really appreciate some action down there. Fill in some gaps, maybe 419, maybe 393. yeah, our MACD is now bearish on the daily. Got red into the 9. Big engulfing candle. Pretty good volume. Been good for a move down. AMC consolidating. Kind of a little cup maybe formed here. Jay's actually the handle. We'll see. Watching AMC more now though, it's interesting how it moves with SPY. Liquor up 16% today. Nice engulfing candle to the upside. Maybe we'll get a bounce. Back up to $1. This big sell-off was ridiculous. Good volume on it too, so that's looking good for a rally if you wanted to trade this. Little swing. GNS had good news, popped up. Pretty ugly double doji on that candle. Good volume on it though. Stayed below that resistance. Stayed above that dollar support, so there you are, you're back in that range. And GME. Still using this line as resistance. One of the two. Rejected here. So see what we get. The SPY looking pretty bearish. I think we'll probably get a retest at least of 16, maybe lower. Yes. Yes. Thanks, Corey, for your donation today. Appreciate it. Appreciate your generosity. We want more. Jay from the Bay, thank you, sir. Hopefully you did well today. On my small, just day trading account, I just have it on my P&L because this account is specifically for just day trading, so I can see it on here. What we did. So, yeah. On the other accounts, it's not as straightforward because I'm holding options, long options, short options. Some have shares. So it's not like I've necessarily made or lost anything. On the one with long options, it's usually just losing because I'm decaying. When with short options, I'm usually flat to green because it's decaying. On my long term, which is usually just shares being held, but I'm turning it more into a theta farm, I did get a hedge of quite a bit of SPY puts. Actually, I think a majority of my account right now is in SPY puts, so it's more than a hedge at this point. So it liked today's move to the downside. And then my other account, yeah, trash. I gotta call them even to open up positions. It's position closing only. Tomorrow? I mean, maybe a little bit, but this is a very ugly close. You might get a gap down and then a bit of a bounce intraday. If you get a gap up, I don't see kind of a rally continuing. It was bad news and the market took it bad. And indicators look bad, and yeah. But day to day, it's like, it's hard to really know. Like, will we close tomorrow lower than here? Not necessarily. We might close somewhere within this huge or large candle at this point that we made. But we could close lower, but it might seem like a flat day because we're gonna, if we gap down and then rally and then kind of come back down, or we gap up and then just slowly melt off, you know, probably won't be as big of a day. But thanks, Jay. Thanks, Guts. Thanks, Tasty. Thanks, Psych You Up. Thanks, Mr. Invest. Appreciate it, guys. Thank you for the thumbs up. We got 23 on the day. Well done on FOMC day. No, they paused interest rates. So another pause. However, they need to do one more this year, I think. Technically, they could do it next year, potentially. Reach what the Fed funds rate. So pausing for this session though. Thanks, guys. Have a good afternoon. See you on Discord. See you. Okay. Peace out.